Hello, everyone, and welcome. My name is Nicola Corzine, and you are joining us today for the 2023 Summer Exit Optionality Bootcamp. We're really delighted for you to be joining us. We have a lot of great content in store for you today. If this is the first time that you are joining the NASDAQ Center, first, welcome. Second, we are a nonprofit that is building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in the field of entrepreneurship. As you're going to have seen in the chat in just a minute, the NASDAQ Center provides all kinds of programs, resources, and exceptional mentorship to entrepreneurs across this world, regardless of race, industry, background, or geography. So we invite you to check out those links and resources. Everything that the center does is pro bono. We don't charge for anything, and we don't take any equity. But what we do ask in all of this is that you continue to pay it forward in that true entrepreneurial spirit that this world is grateful to receive. So a couple of housekeeping rules before we get started today. First, we'd love to know where you're joining us from. So please pop it into the chat. Let us know where you're from today. Second, we are going to be opening up for live Q&A throughout today's sessions. So if you have a question as we go through, please submit those questions into that Q&A function that you're going to see at the bottom of your screen throughout the presentation. And we're going to try to get to our best to get to just as many questions as we possibly can. None of what we do at the center would be possible without our incredible sponsors, our donors, and our foundations who believe in the mission and the work of the center. So to all of them, NASDAQ, Lehigh University, Bank of the West BMO, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft, BPM, and HubSpot for entrepreneurs and startups, we're truly humbled by your contributions, and we hope you're grateful too. So before we get started, I'm going to launch a quick poll. This has been a moment and a half for all of our entrepreneurs. And we want to start with just getting a temperature check of how you're doing right now and today. This allows us to focus in on a lot of the wellness programs that we offer at the center. So by letting us know how you're doing, we both track and trend that over time and make sure that we're bringing forward the right kind of coaches and wellness and mentor experts. So I've launched that poll. If you'll take just a minute to let us know how you're doing in this market climate. It has been a winter and a half, as we lovingly are saying right now, and we appreciate you staying the course and doing so much for all of us. But let us know how you're doing. We appreciate it. I'm going to give everyone just a moment longer to reply to this poll. Thank you. Happy to see that we've got a lot of people who are still optimistic about the market conditions, and understandably, a lot of you that are hanging in and just counting on surviving this moment in time. Fully appreciate that it is one to look into and lean on that way. Thank you for that. I'm going to share the results. It's good to know that you're not alone. We believe in the importance of that for sure when it comes to entrepreneurship. So thanks for your transparency. I've got one more poll that I'm going to ask you to complete right now, and that is, what is keeping you up at night? This is a very important one that actually allows us to know what we need to be building for you. When we do this, it allows us to sort of go forward and say, do we need to offer more marketing support for you? Do we need to offer more finance support for you? Do we need to offer more sales, more marketing, scaling up, pivoting, building out your team, surviving, as we just talked about? So let us know what it is right now that you need. And then our incredible program team at the center is going to turn around and build these out in sprint-like fashions. And you'll see over the next 6 to 8 weeks, a host of experts that the center puts forward in support of these areas that you're asking for today. So that is the model from which the center is able to really be designing and developing in support of responsive, available support for entrepreneurs. So thank you for this. We got a lot of people looking for additional finance help today, scaling up the company, and some team support. I'm going to share those results with all of you. Now, thanks so much again for participating in these polls. I want to give you just a quick overview as to what to expect today. We're going to be kicking off our program with a general market update. Again, this is a very important moment in time to know what is going on and to hopefully get a sense and a confidence that you can navigate it. And then we're going to be jumping into our first panel, which is preparing for an exit. And we're going to do a quick break, a 5-minute break. And then we're going to come back in and we're going to have our second panel, where our panelists are going to share about executing your IPO, followed by another quick break, of course. And then we're going to round it out with our last section, which is really going to cover M&A readiness. Please note the same Zoom link is going to work for all of these sessions today. So if you found us, you're in the right spot. Just keep coming back to this one. And now, without any further ado, please join me in giving an incredibly warm welcome to our first expert and our first presenter to share on the IPO market update. Chris Headrick, welcome, and thank you so much.
Nicola, thanks. I appreciate it. So, well, good morning or maybe good afternoon for folks on the phone. So once again, my name is Chris Headrick. I'm a managing director and I co-lead our technology and business services M&A team at BMO Capital Markets. So I appreciate the time today. I've put together some slides there. There's a fair bit of information on the pages, but I'll try to hit the high points and go through this in a fairly efficient way. So what I'll be touching upon is the US M&A and IPO market and give you some thoughts and highlights on where the market is today and obviously where it's sort of been over the last maybe 5 or 10 years and how that's evolved over time. And then I'll touch upon at the very end sort of things that to focus on in the remainder of this year. So hopefully you'll find it informative and a good conversation. So why don't we turn to page 1 and jump right into it. Thanks. So if you take a look at this slide, this really gives you the overview of the US M&A and IPO market over the last 10 years. So if you take a look at the chart in the middle on the top, that's really the M&A, US M&A market on a yearly basis, where the bars represent the aggregate deal value for transactions during the year. And then the line represents the number of transactions for those years. So as you can see, it's been fairly, moving upward and to the right across that time period. You see a little bit of a blip in 2020 due to COVID, but a very nice rebound in 2021, and then a consistent sort of strength in 2022. And once again, I think the important thing, and right below that is the IPO market, where you've seen a significant drop off in 2022. Once again, the M&A market has somewhat of a lagging effect. So a lot of those deals where they started to see some headwinds in the market in 2022 related to inflation and higher costs, be it interest rates, there was a little bit of a pullback coming in, but it isn't as immediate as you'll see down in the IPO market in the chart below. And then for the year-to-date numbers there you see, once again, there is still what I would say is further softness in the market as we have continued inflation, still high interest rates and the cost of capital, but then also a tightening of the credit markets that we've obviously seen as it relates to SVB and some of the, challenges in the banking system. So the pie chart there on the right just lays out how much of the US M&A on a value basis represents on the global market, about 73%. And that's pretty consistent year-over-year, anywhere from sort of 70-75%. So on the chart at the bottom there is the IPO market. It's the amount of capital that the IPOs are raising on a yearly basis in the US, okay? And the line represents the number of IPOs on a yearly basis. So you see, a fairly strong, steady market through 2019, and then a significant pickup both on the amount being raised and the number of IPOs in 2020 and 2021. So once again, the back half of COVID, significant pickup. And then in 2021, a very strong market. Now in 2021, as I said, dropped off significantly. And I'll talk about this in the next page, where it's very highly correlated in the public markets to what's happening at that time. Where M&A has a little bit of a lag, the IPO markets are pretty immediate. And so that dropped off, recognizing the headwinds of the market. And that's been, once again, if you look at the year-to-date numbers, it's also been fairly soft and not very active. When you look at the pie chart to the right there, you'll see about the dark blue, the 21% is about the US amount of equity IPOs globally year-to-date, which is, consistent. I'll talk about this in a later slide, consistent with history, which is anywhere from about 45 to 20%. So a little bit down year to date, but I'll show you that later. So if we can turn to the next page. So this is just looking a little closer at the breakdown between M&A and equity. So this is a percentage breakout in the bar charts relative to the aggregate total of exits, be it IPO exits and M&A on a yearly basis. So these percentages represent the IPO portion of those exits. So that in 2012 on the left there, in 2013, it was about 20 to 25% of the exits represented IPOs in total value of exits. And it really spiked up in 2020 and 21 to roughly 30 to 33%, you'll see. And the line represents the NASDAQ. So once again, what I'm really trying to point out here is the activity and the value of the IPOs are highly correlated to the market. As the market really ramped up and increased, you see a much bigger and a lot more IPOs occurring in that time period. Once again, not too surprising. Once again, the IPOs are very tied to the strength of the market. And then in 2022, once again, you see that significant drop off, both in the market on the line, and that's the NASDAQ that you're seeing there for each of the years, and then obviously the percentage of IPOs exiting in proportion to the M&A exits. Okay, so we'll turn to the next page. So I thought this was sort of interesting. So once again, it sits outside IPOs and M&A. This is really venture capital investment. But I think it's interesting to see how this is. Once again, venture capital is the foundation for whether it be an M&A in the future or an IPO in the future. It's the investment that they're making in future companies like yourselves. And so what you're seeing here is the amount of capital on a yearly basis in the bars. And then the line is the number of new investments made on each of those years. So once again, very consistent and in sync and correlated with the market. A little bit of a lag. So you see it peaking in 2021. A little bit of a lag in 2020, dissimilar to the IPO, which obviously had a sharp contraction. So this is very much mimicking almost like the M&A, line and trajectory. But then once again, it's fairly dramatic on the year to date or the Q1 numbers that we've got for 2023. So once again, as valuations in the market is trading down and you're seeing softness and headwinds in the market, obviously the venture capital is reacting and pulling back some of their investments. We'll turn to the next page. So now to just double click on the US M&A market on a monthly basis. So you see the chart at the top, and this is over the last 2 years. And I think this is interesting because once again, we saw the pullback in 2022 in the middle, sort of that light blue, royal blue is really 2022. So we saw the pullback from 21 to 22, but now you're seeing on a monthly basis of transaction values on the bar. And so you're seeing a sort of a steady sloping down and to the right. So once again, not too surprising, and this is really reflective of a lot of the headwinds in the market. But you're seeing it now on a month-to-month basis, and then the dark blue there on the right is 2023 activity. So the one I'll point out is that April 2023, the smallest bar to the right there, was right around the time when SVB collapsed, and there was a real sort of dislocation in the banking system and a concern around that. So once again, credit tightening and the fear around that, and then it sort of picked up and rebounded a little bit in March. So and I also think just the charts at the bottom are interesting. So if you take a look at the lower left, this is the distribution of transactions by size over from 2020, 2012, 2017, and 2022. Not a lot of change, where the dark, not too much change in terms of the distribution by size. But if you look to the right and you see the distribution now by value, predicated on size of transaction, you see a big shift in the gray, which is deals greater than 5 billion over the same 2012, 2017, and 2022. So the same time period, What does that say? Well, valuations have gone up for transactions. So that's one. But also there's a big focus over that time period for sort of what I'll call mega deals or bigger transactions getting done. And, once again, that makes sense as you think about over that time period, the cost of capital. And for a lot of those big deals, what's important to that is leverage in bank. And the cost of capital was fairly low during that time period. So, okay, turn to the next page. Thanks. So here's just looking at the US M&A market by sector. And so if you look at the upper chart and looking at the different years, that's really looking at the breaking down by sector predicated on value. So if you see the big sort of trends there over that time period from 2018 to 2022 has been the top two gray sectors shrinking from about 45% in 2018 to about 20% in 2022. And then you see the dark blue at the bottom, which is technology, going from about 11% to about 31% in 2022. So once again, just sort of a shifting, not too unexpected, as technology becoming very impactful in a larger percent of the deals, okay, from a value perspective. If you look below that, over the same time period, it's breaking down the sectors by volume of transactions, so the number of transactions. Not a lot of change over that time period. So similar amount of technology deals getting done that you can see in the dark blue at the bottom over that time period. But obviously, when you look above, they're becoming a bigger percentage of value. So those deals are getting obviously higher value and higher valuations. So we'll turn to the next page. So this slide is going through just this, when you break down the M&A transactions by sector and looking at the valuations. The top bars are looking at all of those different sectors by enterprise value to revenue, and the bottom are looking at enterprise value to EBITDA. So I'll touch on the revenue first. So once again, for the gray represents the last 3 years of multiples across all of those sectors. So the multiples up and to the right, and then they've been, as you see in the dark blue, which is year-to-date statistics for multiples year-to-date, they've been, in the case of technology, up and to the right for the gray, and then a little bit of flattening year-to-date. You see in the case of the financial services sector, nice upward to the right, a little bit of pullback year-to-date. Not too unsurprising in the fact that obviously there's been some concerns impacting the financial services, and so obviously multiples and valuations have pulled back. The next one there is healthcare. So it was strong in 2020 and 2021, right around COVID, very strong multiples, and then definitely a step down following COVID in 2022, and then a flattening year-to-date. And then the rest of the sectors, be it consumer, energy, and industrials, have been, for the most part, pretty consistent. And then EBITDA multiples have been pretty consistent over time. Obviously, you see a little bit of a jump on the technology side. Some of that has to do with just not year-to-date. And so most of that has been fairly consistent. And I think that's where, when I think about transactions going forward, there's going to be a heightened focus on profitability and EBITDA, and I'll get into that in a later slide. So we can turn to the next page. So this slide, I think, is interesting. I think anytime you think about M&A and transactions, I think it's important to understand how the buyer is how they feel, and whether they've got financing, whether they have enough capital, and what is that cost of capital. So that's what some of this data is trying to show. So if you look at the upper table, with the bars representing the aggregate value of private equity fundraising on an annual basis, and then the line representing the number of fundraisings occurring. So once again, very strong, both on dollars raised and number of fundraisings. And what you're seeing though in 22 is a little bit of a drop off, and then a big drop off in Q1 of 2023. So you're seeing less fundraising, less money, less deals from a private equity standpoint. But the middle table or middle chart is showing the amount of what we call dry powder, the amount of capital that all the private equity firms have that have yet to be deployed. And so that, once again, you'd think, okay, that's peaking as the fundraising has been peaking. And then you're seeing it slope off, but not at a dramatic pace, which means they're being a little selective in the deals they're looking at, which is why M&A is tailed off a little bit, but they still have a lot of money and their clock is ticking in terms of putting that to work. So it's about a little over $1 trillion of what we call dry powder is still available to be put to work. Okay. But the other graph at the bottom is an important one too, which has to do with the cost of debt. And so you see, obviously the increase from 2018 to 2020, where interest rates spiked a little bit, then came back down, and now we're seeing a dramatic increase, and we're all probably well aware of that. And hopefully, of course, we'll see. But that's obviously having an impact. It's less so on smaller transactions and more so for the bigger transactions that require leverage. So we'll turn to the next page. I'll double click on the IPO market at a high level. So if you look at the chart above, this represents stacking bar charts for the total equity capital raised on all IPOs for each of those years across globally, okay? And then the line represents the percentage of the equity capital raised in IPOs each year that was US based, okay? United States, okay, in the upper chart. So you're seeing once again, consistent with the trend of the peaking in 2020 and 21, and then a pullback in 22, and obviously year to date. Now you're seeing the percentages of the US. I said at the end, you see there it's about 21% of the global market. You're seeing it bounce around a little bit year over year. And in the time periods where there is strength, be it where it's hitting in the sort of, north of 25 or 40 or 45%, which is in 2012, 2013, and also in 2020 and 21, a lot of that is driven, if you look at the chart below, which breaks down the activity by sector. So it's breaking down the IPOs within the US by the sector that they are in, by the companies in the sector that they're in. And so, there's a lot going on there, but what you're seeing, what's really doing that in the first 3 years, 2012 to 14, in terms of the US percentages coming up, it's largely driven off an increase in activity, and obviously you could say valuations for companies that are either in technology, financial services, or healthcare. And it's the same situation in 2018, 19, 20, and 21. So that really becomes sort of the strength in creating that lift in the market for IPOs. So we'll turn to the next page. So I think this is, a little bit of a high level chart just to touch on value in the size of IPOs. And this is based on amount raised. So what you're seeing on the bar charts over the time period is the average amount during the year of the IPOs and the amount raised for those IPOs. And then the line represents it's a revenue multiple across all the IPOs, just to give some, doesn't break it down by sector. So it's really meant to show some trending here. And so the line is very much in sync with the market. Once again, not surprising. And so is the size of the IPO. As the valuations increase and the IPOs increase, the activity, so is the size of the IPOs that's occurring during the year. So, and then you're seeing a dramatic decrease, once again, in 2022 and year to date. Now, some of that in 2022 and year to date probably has a little bit to do with the businesses that are going out, be it less technology businesses that are have a tendency to be valued off revenue multiples. So there's a little bit going on underneath this, but I think it gives you a sense of sort of what the valuation's occurring and how very much it's in sync with the overall market. So I thought this was an interesting slide and some data. This is looking at a scatter plot of SaaS software businesses, publicly traded. So it doesn't have to do necessarily with IPO, but it does have to do with valuations. And what you're seeing here is you're seeing on the north-south axis, you're seeing the enterprise value to next 12-month revenue multiples for these, publicly traded software companies. On the horizontal axis, you're seeing, what people tend to say is sort of the rule of 40, or the combination of the next 12-month revenue growth rates and the next 12 months. And what does that mean? And what's the correlation of those factors to the multiple of the business? Okay. And so you'll see, and they're broken down into sort of tiering. The lower, when you look at the aggregate of growth to margin, those are the less than 20%. And then on the far right, when you look at the combination of growth and margin, that's greater than 60%. And what does that mean from a multiple standpoint for each of those groups? The far right grouping or cluster of those data points, 10.7 times forward revenue multiple. And on the left, those groups are roughly in the 6 times difference in terms of companies that both have strong profit margins and growth rates are getting obviously a significantly higher valuation and multiple. So you turn to the next page. So what does that mean? I'd say here are just some high level sort of comments on sort of what I think about or we think about for the rest of 2023 and what people, when I go out and talk to a number, whether it's companies or private equity firms, sort of what they're thinking about and what's on their mind, and some of those being positive, some of them being concerns. The first one is, where's inflation? Where's it going? And obviously the interconnection with interest rates, right? And that's really important to understand. I think you can even combine that obviously with the unemployment rate. And how's that the economy, and what does that mean for the business? I think obviously what's also cropped up, over the last, as I spoke about earlier, has been the tightening of the credit markets. And what does that mean? And so I think we're starting to feel some stability there, but I think it's been a little bit of a shockwave coming through with some of this, some of the smaller banks and some of the super regional banks. And I think the other concern people are talking about obviously is sort of where is all this commercial in general. But I think, an important point here is that buyers are definitely very focused. And this is very much different than what I'll say last year and even prior years. When you think about probably more directly related to technology businesses, but buyers are very focused on near-term profitability and the prospects of the business than just growing at all cost and ignoring, the impact either on margin or on potentially negative cash flow. And so that sort of relates to just the prior slide. Are we gonna be in a recession? Are we gonna have a nice recovery? Or are we gonna have, future growth? And I'd say, one of the sort of cliche things that I say, and probably say it all the time, but it's in this market in general, it's probably never more important to have a quality business, and also to know how your business is going to perform as it relates to some of these challenges this year. So that's it. So hopefully that was helpful, and happy to answer if there are some questions or further conversation. So.
Oh, Chris, that was such sage advice. Thank you so much. And yeah, there were actually just a couple of quick ones I'd love to hit before we move on.
Yeah.
Just from a knowledge perspective, did the numbers that you were showing on the IPOs, did those include SPACs? Was that
It did. So I pulled out, no, it's a good question. So it doesn't include SPACs, and I also pulled out REITs.
Okay.
So it's just focused on what I think are sort of true entrepreneurial sort of growth businesses, rather than SPACs, which are unique, and REITs, which are ongoing and sort of tapping the market for ongoing capital.
Okay, fair.
Good question.
We had a question that came in that's curious from your perspective, from your expert perspective. Do you consider the 2021 IPO numbers as the start or the signal really of the bubble that emerged here?
So the start was 2021, the start of where the bubble sort of burst. Is that it?
Yeah, it was at the start of the end, so to speak, for the
I think there was I think there was a certain amount of pent up demand. And I think, it was an interesting time coming out of COVID. And so there was a lot of activity. So I do think there was some sort of concentration of activity in 2021. But I also think if you take a look at sort of where the market is today, I still think there's good strength and companies are performing well. And I do think that there's a lot of, whether you look at AI or other areas where technology and innovation across sectors, is creating opportunities for businesses. So I still think it'll come back. I think the challenge is we've got to understand, I think people are looking for solid footing. And I always say sort of they're looking for a vector. They want to know which way it's going to go. If you don't know which way it's going to go, that's where people sort of pause to understand that, are we going to go down a little bit more until we hit the bottom? Or are we going to go up? And I think that's where we're in sort of a little bit of a funny time. And I think we are in very good sort of position until we had some challenges with SVB and First Republic and some of the banking space. And that caused a little bit of pause. So I still feel very optimistic. I think when I talk to private equity funds, they're actively looking to put money to work and are very interested in looking at quality assets and doing deals. So.
Well, speaking of looking for intel, if intel is to be found, and confidence factors, we had another great question that came in saying, if you had the crystal ball and could look ahead for the rest of the year, what do you think it might take to reverse the sharp decline in VC activity that started at the beginning of this year? Are there elements that you think we should be paying particular attention right now to see an increase in activity in venture?
Yeah, I think if we could get stability and knowing direction with the cost of capital, I think that's important. I think if we can work through the system where we are, just get a little bit of the tightness in the labor market, just a little bit softened. Doesn't need to go down. I'm not asking for that, but I think if we can just get a little bit of stability there and a little bit of, optimism on that side, I think then we can be in very good position to have a very good back half of the year.
Well, there we go. What a positive way to end the conversation. Chris, thank you so much. We really appreciated it. The slides for anyone joining a little later are going to be made available. Chris, we so appreciate your time and your insights today. It's really been great to have you. Thank you.
Great. Thank you.
All right. Well, up next, we have an incredible panel who is going to be taking us on the next part of our journey together as we look at preparing for an exit. But before we do that, I'm going to launch another poll really quickly because we have a few topics that we're covering today. We're going to be covering IPO readiness, M&A readiness, and we'd like to know what you're most intrigued to be hearing about today. So if you'll take just a minute to let us know, this will just help us balance the amount of time that we allot for Q&A and really make sure that we're engaging with all of you who are spending so much thoughtful time with us today on navigating this market, a challenge and a half to say the least. But as you've seen with experts like Chris in our upcoming panel, we're going to do our best today to try to give you as much confidence as we can to help you see around this corner that's ahead of us. So thank you. It looks like we're about evenly split. So a lot of people excited to be able to see both or hear both parts of the conversation. All right, so let's turn it over to those people who are going to help us do just that today. We have an incredible moderator joining us, Sally Wong. She's a managing director at KPMG. Also beside her, Florian Lindstaedt, managing partner at KPMG, and rounding us out, Michael Labriola, partner at Wilson Sonsini. Everyone, thank you so much for joining us, and we look forward to this conversation. Sally, over to you.
Thanks, Nicola. Really happy to be with you all today. As she mentioned, I'm a managing director with KPMG's Accounting Advisory Services, work within our deal advisory services, and have been helping clients a lot with accounting and financial reporting considerations in both M&A transactions as well as through their IPO, whether it's through a SPAC process or through a more traditional IPO. And as I start to ask questions, whoop, there goes my light. I'm not moving enough. As we start to ask questions to our panelists, I'll let each of Florian and Michael introduce themselves a little bit before they launch into their answers. But in the interest of time, I know we're running just a little bit behind. We heard some really interesting stats in the previous panel and understand that, yes, there's a little bit of softness in the market, and maybe that's an understatement. IPOs have slowed. There's a slow in M&A market. However, these conditions can reverse pretty quickly. There, as I think a lot of you are aware, there's a very finite window to capture ideal valuation and to make sure that you are, while there is limited dry powder, so to speak, and more limited M&A activity, there is still activity out there. So how do you capitalize and be one of the forerunners in contention for some of this M&A activity? And, given the uncertainty in both, and we kind of saw just in this poll now that there's a little bit of a 50-50 interest in both, we wanted to talk more broadly about an exit. So whether that's M&A or IPO, I think what we're going to cover in this panel are some of the things that you can consider in both and to give yourself some optionality. So maybe with that, I think I have a first question for Michael, and this is a little bit more broad, but can you discuss some of the factors that entrepreneurs should really think about when they're considering the right time to exit? And maybe what are your top 3 takeaways that you recommend companies think about?
Sure. Thanks, Sally, and good to see everyone. And quickly, by way of background, my name is Mike Labriola. I'm a corporate and securities partner with Wilson Sonsini, Goodrich & Rosati. We're a Palo Alto originated law firm, although we're global and based in our London office. And I work with tech companies and life sciences companies predominantly, particularly in cross-border deals around late-stage growth financings and IPOs and M&A. So with respect to your question there, Sally, I think I kind of bucket it into 2 different things here, which is, should you do an exit and could you do an exit, right? And I actually think those are threshold questions that a lot of the folks that are on this call probably have pieces of. But one of the things that I find with a lot of our clients is there may be inconsistencies across the organization as to what people think is the vision. The CEO may be going one way towards a listing. The CFO is looking and saying, I don't have the numbers to support that, but I do have the numbers to support a sale. The investors may have aspirations of a more certain outcome or a much more rocket ship type outcome there. And so getting that alignment, I think, is actually, and I realize that sounds highly conceptual for a lot of folks there, but it's pretty important. And sometimes for individual stakeholders in the process, whether it's part of management that is tasked with get us ready for an exit, sometimes you have to have that threshold conversation. So I think generally speaking, should we is actually one of those big themes that I would start with there. And there's some mechanics behind that I would highlight. One is going through the company's waterfall, right? The liquidation preferences, the qualified IPO triggers and the charter, things like that. Understanding, the drag along provisions, the consent provisions, things like that, and understanding who do we have to talk to, who are the stakeholders that we will have to go through to make a deal happen. And that's how you come to a conclusion around should we, in a lot of respects there. It's first off, who do we need to get to endorse this? And then second of all, are we all going the same direction? With those folks, I usually say, let's ask the question, what are we trying to accomplish, right? Are we trying to accomplish liquidity? Are we trying to accomplish stability for the organizations in a longer horizon to grow? And all of those are questions that I think are really important to start with those key stakeholders that are the decision makers in the organization. And sometimes I think we find that many of our organizations aren't connecting the dots until it's too late. So I think that's a key theme that I would point to. Then the other thing is, as I mentioned, also the could we do it, right? And I think there's some, there's a whole bunch of points that we could talk about at a banking level, at a governance level. And when we're talking about just broadly preparing for an exit, I kind of view it as there's two really big themes that you kind of start with early, which is one, do we have the financial reporting and financial accounting functionality? I don't want to steal on my friends at KPMG here's thunder here, but I think this is a huge deal. And full disclosure, I'm a former public accountant myself here. So I think this is a big deal because it's a long pole that takes a lot of work, a lot of collaboration with your auditors, with accounting consultants, and it just takes time to develop that. It's not just the historical accounts. The historical accounts are going to be important to somebody who's buying you, but it's also the full-blown FP&A function around modeling and understanding how the business operates and where all the pieces are. I think a lot of organizations underappreciate how complicated that is until it's too late. Oftentimes it's a startup and then they are off to the races, and suddenly somebody's using QuickBooks, and now you're having to produce reports for sophisticated investors fairly quickly. So I would say that's another one of those factors or items that I would put high on my list of looking to. And then the last part is I consider to be kind of the housekeeping part. So I alluded to who needs to be, who needs to consent as part of the should you discussion, but also the could you discussion. There are things like shareholder consents, board consents, customer and partner arrangements if you go down an IPO path versus an M&A path. So looking at what happens when a transaction occurs and understanding that, and talking with your legal function and understanding what they know about the way the contracts all work and that outcome there. There's also regulatory hurdles, right? Are you in a regulated industry where you have to get permission from a banking regulator in your jurisdiction, for example? Are you going to trip up antitrust concerns because your short list of potential buyers are people that also are competitors? And even if you're not competitors, there's a process in many jurisdictions, like in the United States, where you have the Hart-Scott-Rodino Act, where you have to do a mandatory filing. And then lastly, we've seen a rise of national security considerations the past couple of years. You saw the CFIUS rules in the United States, the UK NSI Act in the United Kingdom, and then the various parts of the EU are increasingly adding scrutiny around their national security considerations around can deals occur cross-border in sensitive technology. So understanding the art of what you can do, I think, is really critical to a process there, whether you're going down an M&A process or an IPO process or something else. So sorry, there's a long answer there for you, Sally, though.
No, that's perfect. And, not to beat the dead horse here, but I am an accountant, so I'm going to have to talk about this a little bit more, which is re-emphasizing the importance of having audited financials. A lot of our clients will say, and you might be sitting there saying, hey, I've been through an audit before. I've done this. I have everything in order. There's realistically, when you go IPO, you're going to have to be subject to what's a PCAOB audit, which is subject to different standards and a higher level of scrutiny, a lower level of materiality from an AICPA audit for private companies. And even if you're not going through an IPO and you're looking through an exit through an M&A transaction, if the entity that is acquiring you, or perhaps it's a reverse merger, you're going to become public very quickly, you're still going to be subject to a different set of scrutiny and maybe even a different set of auditors. So having your financials in line and understanding what the uplift is to get from a private company set of financials to a public company set of financials is really important. When you get into, it's not just the financials themselves, it's anything in a filing. So including like MD&A and whatnot. And I think we're seeing that there's a focus on gross profit and gross margin rather than just EBITDA at the end of the day from some of these investors. And so being able to articulate how your key KPIs, being able to articulate what your gross margin is, maybe with your different segments, your different revenue streams, and all of that requires you to have the ability to track some of your expenses and what they relate to, and being able to clearly articulate that. I've had clients where they have just this general like G&A expense category, and when it comes time to trying to articulate their value and support the valuation maybe that they're getting in negotiating a deal, they're having some difficulty articulating that because they just haven't historically tracked some of that data and separated that out. So things to think about as you're kind of gearing up towards your exit. All right, so in the process of capitalizing on this ideal window, we also heard about a tightening credit market and inability to access capital, and so, or maybe a little more limited access to capital. So Florian, how might some entrepreneurs address and resolve these issues related to cash flow, and maybe get some more access to liquidity without having to rely on external funding?
Yeah, no, that's a great question. And so just quick intro, Florian Lindstaedt, I'm an MD in KPMG strategy practice. I lead the working capital offering, so I'll be talking a lot about working capital here. And I think that rhymes really well with what we heard earlier from Michael and even Chris. The key thing is you don't need a bank to improve your, or any external funding to improve your cash position if you can improve your working capital, right? So that's really good news, actually. And right now, this is more valuable than maybe over the last couple of years, because in the past, there was maybe easier access to funding. Interest rates were lower, cost of capital was lower. So it was cheap or easier to get to cash. But now it might be a little more difficult. And especially if you want to make sure that your organization is prepared for whatever might come, it's really important to ensure that your revenue rhymes with your cash flow. And that's probably easier said than done, because yes, there is going to be times when an organization as it grows needs cash and needs infusions. But overall, it's, as you're growing, really important to keep track of, is my cash flow making sense relative to my EBITDA and relative to my revenue? There are extreme cases where organizations basically fail to, you record your revenue, so the accounting is in order, you are growing, you're getting customers, but the focus is not as much on the cash. And so you might end up with issuing payment terms to your customers that once you've granted someone the right to pay you really late, they'll always insist on that. You can barely, or hard, it's hard to walk that back, right? So being really rigorous as you grow, and not just saying, yeah, sure, you can pay me in 60 days or 90 or 120 days, because that's what your customers will continue to expect. It's things like making sure you actually invoice and not just record the revenue, but making sure you get the invoices out the doors to your customers on time. And if they don't pay you, follow up with them, and don't be embarrassed to say, I sold you a thing, I provided a service for you, we have a contract, I need the money now. This is important, and it's very tactical, blocking and tackling, but because as organizations grow, typically there is no one owner of all things working capital. So quote to cash, procure to pay, and forecast to fulfill if you have inventory. It is easy as an organization grows to kind of lose sight a little bit of from end to end, these different pieces. And then all of a sudden you have different departments, different people who are in charge of maybe just the invoicing or just the collections or just negotiating terms with your customers or your vendors. And if you don't connect those dots, you will get inefficiencies in those processes, and you will get dollars stuck, quite honestly, in your system. That in a time like this, and in general, as you're growing, you want to make sure that you're not ending up with dollars stuck in the system. So being really focused on the process, being focused on the visibility, on metrics, and having an insight into that is really important as you grow. And Michael pointed out correctly, make sure you understand your FP&A function, right? There has to be somebody in your organization who actually maybe not owns moving the needle on all these pieces of your liquidity and your working capital, but has a visibility into it and can raise their hand and say, hey, things are going well over here, or maybe we need to adjust and tweak things here.
I mean, Florian, what are some of the triggers? Like if management is looking internally, what are some of the things that might signal, hey, we might need to take an end-to-end look at this, or we might be having an issue with our cash getting stuck where it shouldn't be?
I mean, there's different ways of how you can find this. The closer you are kind of to your customers and really understanding, are they paying you for what you have sold them, the better. But in the end, it shows up in your balance sheet, right? But that's a symptom. So if you look at your balance sheet and you say, my AR balance keeps growing way faster than my revenue, that's a sign that something is not working properly. There are metrics you can calculate, like day sales outstanding, and there's even more operational things you can calculate if you have the system, the access to it. But fundamentally, it's if you're seeing the dollars on your balance sheet, pay attention to that. It is very tempting, especially in growth mode initially, to think about your revenue and to think about maybe your EBITDA, because that's something that multiples are for. And so most organizations early on get a focus on their P&L, and that's good and that's important. But don't forget your balance sheet part, especially if you have inventory, if your business buys or manufactures things. Really pay attention to, am I buying the right things? Do I still need to buy the things that I thought I need to buy? Or are you, to exaggerate a little bit, accumulating dusty things in a corner of your warehouse and you keep buying more of it, right? That can really hurt you from a cash flow perspective, and it's really hard to unwind. So staying on top of, what is my inventory? What is my inventory turns? What are my receivables? Am I incurring bad debt? Am I getting complaints from vendors that they're not getting paid on time and they want to shut me off from maybe providing deliveries for me because I don't have my act together to pay my vendors on time? Those are all signals that you can see in your organization from a numbers perspective and from talking to your sales, your procurement, your collections, your inventory management to understand, is this running smoothly or are there signs of breakage?
No, that's really interesting and very applicable, I think. Is there a difference, would you say, or how would you evaluate a business that maybe is more capital intensive upfront versus a more traditional software or SaaS type of business? What are some of the key differentiating recommendations that you would typically have?
I would say especially if you're thinking SaaS or software, the billing is really important, right? So come up with a good cadence of when do you invoice your customers? What are the triggers? That's important for the accounting, for the revenue recognition, but it's also important for you to understand, when will I actually get paid? Because if you're a software business and you have software engineers, that's payroll. You need to pay them every month. You have probably servers, you have infrastructure costs. You're paying those vendors monthly or weekly. Are you really understanding what you're signing up for with your customers on when will you get cash? So you don't have this very lumpy, at the end of the year, I get to send the big invoice, but the whole year I had to pay maybe my infrastructure cost and my employees. So understanding the timing of your cash flows, the inflows and the outflows to vendors, payroll, and the inflows from your customers. That's extra important if you have long contracts, whether that's project billing or that's kind of annual billing for services. If you're very capital heavy, so you're buying equipment or you're buying inventory that you then have to manufacture with, you might have very long lead times, right? So you might have to place an order in January for the product to show up in March. So you're committing in January to a certain volume, a certain dollar amount that shows up in March. And then you have to pay your vendors maybe in April, but then maybe your manufacturing takes 2 or 3 more months. So now you've committed in January to a volume that might be a product in the late summer, and then you send your invoice and then you get paid in October. So you might have a very long cash conversion cycle of, when do I commit to some expense? When does the cash leave my bank account? And when do I get money back? And that timing, again, is the more important, the longer those lead times are, and the bigger the dollars are, quite honestly.
It's really helpful. Thank you, Florian. I think that's great from a tactical perspective, right? Because I think a lot of the times we talk more high level about, oh, you need to have a healthy balance sheet, access to working capital, but not a lot of people are talking to have good discipline around some of that and to free up your capital. So we'll get back to you, Florian. I think I see some questions already in the Q&A that I think you'll be best suited to answer. Maybe let me switch gears a little bit then back to Michael to talk about, all right, again, this is optionality, right? So M&A, IPO, what are some of what can you do to assess your potential exit opportunities? And maybe what is the best options, or how do people determine what the best exit options are for their business?
Okay. So first off, that's a really, really deep question. Fortunately, we have 2 more panels later today to talk about the different options. But at a high level, there's a couple of high level ways to think about it. And actually, what I do want to commend, I think on Florian's update there, one of the themes there that I think is really, really critical is the way you have a lot of optionality is by making sure that you have control of the business and you're not forced into an outcome. So it's pretty interesting in situations the past couple of months, probably a year and a half or so, where new rounds of financing have been more difficult. We've seen people go down, quote, exit paths that were not really exit paths, right? The way that they would like, right? The traditional, up into the right trade sale or M&A sale or an IPO has been more limited, and a financing round has been more limited. So as a general matter, one, assessing your options is a function of how much runway you got. There's another kind of key threshold question that I like to look at with my clients, because oftentimes, you look at the stat that was put on at the earlier presentation that Chris did about here's the number of IPOs, this is the number of the relative dollars in M&A and IPO, right? On average, your average exit is is mostly M&A, right? It's like 80% of deals go down as M&A. If you look at the long-term averages of exits, right? That's a function, I think, in part of, to your question, Sally, about what are your options, right? One of the things that's critical that you can assess before anything is how do you look at this business? Is this a business that you look at historically, and the past can define the future, right? You've got a trend line. Or are we at an inflection point where we have to talk about the future? And I realize that sounds a little silly, but there's some legal points here and some banking and finance points here to come together there. When I was an accountant, I always found it interesting that I was always auditing last year, right? So I was looking at last year's numbers. I had the benefit of hindsight, and oftentimes the accounting function is focused on that there. In an IPO, for example, at least in a US IPO, you're not generally giving forward-looking projections on a business there because there's a whole bunch of legal risks with doing that. So as a result, if you look at the successful IPOs, they are the ones that have historical financials that show a trend line that you can basically project out to where you're going based on the past there. If you don't fall into one of those buckets, an IPO is a difficult road for you. I'm not saying that because you're not a great business, but it's just hard to tell the story. And so that's really one of those key threshold points that I often say to our clients is like, could we even tell that story in the boundaries of the law and the boundaries of how the bankers market deals? If you can't do that, then we're looking at some form of M&A, whether it be traditional sale, it could be a SPAC, which is an interesting difference because SPACs have more ability to use projections than a traditional IPO because of the way the regulatory scheme works there on that. Alternatively, you could be looking at smaller transactions like, do we need to do a secondary for some of our parties, right? Employees, individual investors, founders, what have you there. And it really comes down to, again, how comfortable are you speaking about the business, whether it's, the past speaks for itself, or we have to tell a story about the future on that one there. I think those are probably the threshold questions that I usually find in most of these discussions. I think then, of course, the options are also how soon do we need to do it? Do we need cash? Do we need, is there a strategic imperative because somebody's going to eat our lunch? We've got to work with another party in the industry to get caught up on something or stay ahead. Those are all, I think, compelling factors at a business level. But I think at a fundamental level, can you do it? Is comes down to how you describe the business there, in my experience.
Right. I think you mentioned briefly, SPAC, potentially reverse listings. And I think that in some cases, in tightening your story that you're telling, so to speak, sometimes it might require a divestiture of a piece of your business and things like that. So how do each of those things, whether it's maybe even a small acquisition to strengthen or to enhance your capability as a company that you may not have, or expand maybe inorganically your revenue, versus, you might need to divest a non-core portion of your business so that you can focus on profitability in the immediate term. How do each of those things impact, you in an IPO scenario versus an M&A scenario?
Mm-hmm. So I think the one thing that we hear a lot is people come in and they go, well, I've been told a SPAC can go faster, or reverse listing, can go faster than IPO. The key word there is faster, right? One of the most valuable commodities for a lot of high growth companies, besides money, is time. Actually, one of the VCs that we work with makes one of their platform guys actually has a great statement. He said, we provided the money. The next most valuable thing we can do is provide more time to our entrepreneurs. So that's why we try and, help streamline things. I think there is a complete misconception that a SPAC or reverse listing is materially faster than an IPO or a direct listing. If properly executed, both of them take about the same amount of time there. I also think an M&A transaction similarly takes more time than people give it credit for. Oftentimes they go, oh yeah, we'll get this done in a couple of days, but the time behind it is often weeks, months in the making, right? And so I actually don't think there's a material difference in any of those when it comes to time. I think there's material differences in costs on approach there. Different companies, if you're going for, depending on the size of what you're doing, going down an IPO path is expensive, but it may be worth your while if you're a big enough size, right? I think realistically, you've got to get to an offering size of, north of 100 million to justify a lot of the expenses in a lot of cases here easily. Because it's gotten more and more expensive to pay for accounting fees. And that's just not the audit for the front end, but it's the ongoing compliance and whatnot, the legal fees, the printers, the bankers, all that good stuff, right? You trade that off against the M&A. Well, sometimes it falls in your lap and you're not paying a banker fee. It's a different story if if you've got a process going with a banker out there selling you. They're oftentimes taking a pretty good sized fee as well. So I think looking at all those options, I would say there's not going to be radical difference in cost. There's not going to be radical difference in time in a lot of cases, even though I think some people think that there is. So I think in the end, it comes down to what's best for the business. If properly executed, all those paths can get you there. Again, I'm going to go back to probably your favorite theme here, Sally, which is having the financials in order goes a long way on that one there. Because if you don't have the core financials, if you don't have your data room in order so you can it's all packaged up so you can pick your option, then you're going to be behind the curve, right? No matter which path you end up going down. So I think those are kind of table stakes to do a deal in an efficient manner there. I do think, reverse listings, SPACs are tools for certain types of companies that don't, whether they're not necessarily raising large amounts of capital, but they're an inflection point story. I think that's an interesting and compelling, potential. Direct listings are an interesting and compelling potential for certain companies that have a large and diffuse shareholder base that don't need to raise. They can raise privately, and so they don't want to pay for the fees. But if you notice, most of the direct listings are still paying for bankers because they're trying to attract coverage as well, analyst coverage. So again, I think it comes down to strategically, is it a buy versus build decision in a lot of cases here, whether you divest something, buy something, or go out and raise the money to build it. I think it's still fundamental in that regard there. And that's a question that I think it's important for the accountants and the lawyers to stay very close to, the business team, whether it's the chief product officer, the chief revenue officer. What is it that we're trying to accomplish out of this strategy, and feeding that up to the, to the CEO in every organization that says, on one hand, we go faster on this one. On the other hand, it costs us more. So I think that's pretty critical on all those paths there. So.
Yeah, and regardless of your path, right, what are some of the through lines on what you consider essential in building a strong exit plan? Because I think there's some fundamental things that are going to be the same that you need to prepare for, regardless of whether it's IPO, M&A, and what vehicle you use to go IPO.
Yeah, I think this is, we can get definitely more granular on kind of the later panels today, I'm sure. But I think when you're talking about any exit, having a strong team is important. A lot of time investors, founders, they get uncomfortable by having G&A expenses, right? They don't want to have, nobody wants admin on the P&L statement there. It just freaks people out. Totally appreciate that. Because it's hard to see the return on it. But, having a strong chief people officer, having a strong CFO, having a strong controller, financial FP&A type there that can do all those functions efficiently, that pays off when it comes to the exit. It doesn't matter if it's an IPO or a sale or something, more targeted, right? If we're going to do a secondary transaction, all of those functions, are pretty critical to successful execution. Companies spend around, the comp structure and the options, for example, on a sale or on an IPO, the amount of preparation for getting that all in place. So employees can trade and, what they expected to have or to get out of their equity comes true. All that I think is very, very critical. I left out also, of course, legal, not to be self-serving there, but the legal function and kind of understanding where all the bodies are buried in the organization, I think are similarly important. Do you need to have somebody who's an M&A, deal whiz or the IPO securities pro as your general counsel? Probably not. Having somebody who's conversant and who's been through a process like that is helpful though, right? And on the team, it doesn't have to be the lead. We looked at some stats a couple of years ago, or over the past couple of years. We looked at the top 30 or the most 30 recent SaaS IPOs through the middle of 2021, when kind of the last wave happened. And if you look at that, 70% of companies listed amongst those had either a general counsel or a CFO that had previously been a public company officer. And now, mind you, 20% of those organizations had a CEO that had ever been a public company officer before. So the CEO looks to their C-suite for help. And that doesn't mean that you have to have everyone has public company experience, but making sure you got somebody in the organization that has been there and done that, I think is a big deal. So don't underestimate and underinvest in that. I think another element that's pretty important is going back to the do what you say what you do theme about the financial statements is, investors value honesty, right? And so when you're going to go out there, whether it's a buyer in the company or institutional investors that are going to buy shares in an IPO, having a track record of performance. We've budgeted it, we executed on it, and you can see the results on that one there. I think goes a really long way in the messaging that you go to, whether it's a strategic buyer or Fidelity who wants to buy shares in your IPO. I've had entire entire M&A processes. We get called in. We said, help us negotiate the deal. Okay, well, we haven't worked with you previously, but of course we'll do that. We've had processes, come to a grinding halt, not because of legal breakdowns, but because the company's results were not as promised. They got under the hood and they said, wait a minute, you told us X. Instead, you were doing, you weren't being fraudulent or, untrustworthy, but we just didn't have confidence in your numbers. And when you're a public company, you got to be able to If you're the buyer in that case, you've got to be able to know that you can close your books there. So I think that's another kind of key element. I mentioned earlier on, consent rights, making sure there's not a third party that's beyond your control. Like if there's somebody that can shut off one of your contracts because they don't like that you're getting acquired by a particular party, or they don't like that you're a public company and you may have to disclose more about your business, that can be pretty fatal. So understanding if you're beholden to a third party is a pretty big element that I think is critical. And then lastly, I have one of my themes for this past year I've been talking to clients about is avoid the idea of people staying in their lane. One of the things I increasingly discovered amongst our clients, and I think this has become more apparent in kind of the post-COVID environment, as well as with the slowdown in transactions, is there's people that some folks are in the C-suite chair that haven't been through a transaction before, and so there's trepidation around showing that they haven't done it before. That's okay. Most people haven't done it before. And so the other thing is there's also fear of, am I going to lose my importance because I'm the person that does this? And if people understand what I'm doing, then maybe I'm not as special, right? The best IPOs, the best sales that I've done have been deals where the CFO, the chief people officer, the general counsel are almost interchangeable in the sense that they just work fluidly together. They talk all the time. They talk to the CEO. I just think that's a huge, success factor for any organization. Creating that line of communication across the silos is a really, really difficult thing to do, but that's the hallmark for success in my view on exits there. So I'll get off my soapbox on that.
No, I agree. And on your point on G&A and getting your kind of plumbing straight, it's not the funnest piece. You're plumbing and electric in a house, you're not going to see it, it's behind the walls, but when it stops working, you definitely know, and you're going to feel the impacts of that. And we always say, accounting, financial reporting, it's not going to drive a deal. Nobody makes decisions based on an accounting result, but it can definitely stop one. So I'm now going to get off my soapbox. We're a bit on time here, but I want to give each of you, Michael and Florian, a chance to leave this group with your key takeaways. If you were to take away one or two things from this session, what is it that you would impart on this audience?
Florian, you want to start? Or
sure. Yeah. I mean, I'll probably double down on what Michael just said and what Sally said, right? The acquisition process or the IPO process, it's very, I don't want to call it intrusive, but it's hard, right? You have to have your back office in order. You have to have your data in order. Michael mentioned the data room, right? It can be overwhelming, and it's never too early to really get organized and understand how your business is running. Yes, the revenue story is super important. Yes, the profit story is super important, but having those other pieces in place so that you are, when somebody starts asking you the questions, how does this work? Why are these numbers what they are? Being ready to explain that and not having to scramble behind the scenes and then figure out, oh, I never looked at this metric, I never paid attention to this, right? So really having an understanding of the financials and the organization of your business as you grow, that is important. Otherwise, it will grow and it will not be orchestrated how you grow. And then really think beyond what your ERP system tells you would be probably my guidance as well. We talked a little bit about accounting. Yes, accounting is a rear view mirror, and it's super important. And I'm never going to say don't cut corners on the accounting, right? Don't do that. But it doesn't tell you what happens next. It is not driving operationally. What do I do tomorrow? What does my business look like a month, a year from now? So having a strong ability to understand the real drivers of your financials of your business, that's the FP&A function. But then also having other parts of your organization really be in sync. And to Michael's point, these should be talking to each other, these functions, right? You shouldn't have silos in your organization. Everybody does their thing, but it doesn't turn into one story of how does your back office support your growth. and your profitability, so that you can really then understand what are my metrics, how can I forecast them. So when you get the hard questions or you want to tell somebody the story about your business, you're equipped to say, this is how I'm growing, this is how this translates into ultimately dollars in your bank account, because that's what is important. How do you get EBITDA and cash? Because that's what people buy or acquire or invest in your business for. They want to get some kind of a cash return in the end. And being able to tell that story from the top line, from your contracts, from your customers, from your products, all the way down to, this is how I turn now and in the future it into money in my bank account. That's, I think, probably the key takeaway. There's a lot of metrics, there's a lot of ways of doing it. Sadly, your ERP system will not do this all for you, whether you are on a big system or a small system. A lot of these things require really understanding your business, building that organizational muscle in your, I'm going to say it should probably start with the FP&A and the CFO function to really drive that insight.
I'll emphasize the same thing with Florian, which is I think it's teamwork. It is the best organizations lever everyone across the organization to get the best outcome. And so I think our takeaways are very similar in that regard, which is use what you got and use all the resources. Don't go into an exit with one hand tied behind your back, because people aren't coordinated. So.
Perfect. Thank you, Michael and Florian. That was helpful. I learned a lot from it as well. Maybe I'll turn it now over to Nicola.
Yeah, thank you so much. I mean, you've humanized a very worrisome topic, I think, for a lot of founders. So thank you for that. Thank you for the practical tips, the strategies. We've got about 10 minutes left. So if anyone does have any other questions, now's a great time to try to pop them into the Q&A function. Thank you to everyone who's been doing that and for the pre-submitted questions. I want to come back to the teamwork making the dream work moment that everyone here has talked about so much today in various ways. Realizing that for a lot of founders that have taken in outside capital, there can often feel like this tension between who has the keys to the kingdom when they're really deciding the strategy of what exit priority to take, especially in a market moment like we're in. So a two-part question that I'd have for you, combining some thoughts that have come in today. One is, as you look back over last market cycles, be it 09, the one that a lot of people often go to, or any others, are there best tips and strategies that you would encourage people to either slow down, pause, reflect on, that can guide considerations across the team dynamics with outside investors and stakeholders as they think about what is the best strategy to take when it comes to an exit in a market moment like this? And number two is, how do we even suggest that founders have that conversation with investors around a board table? Should it be earlier rather than later? And what are some things to potentially avoid or lean into when it comes to those conversations of liquidity? Open to the floor. Would love people's thoughts on this, because I know the strategic and sort of the psychological approach is often 2/3 of the battle in these types of things.
Michael, you have any thoughts?
I can kick off perhaps. So I'm actually reminded of my partner, Marty Corman, who sits in Silicon Valley, and I think folks have come across before, had a profound statement one time, and I don't know if it's profound or not, but it was profound to me, that about, who should be the last person to talk about if we're going to sell or not. And actually, oftentimes it's the management team. It's one of the pitfalls that I think we often see is a situation where, whether it's a founder or a CEO who's pushing an exit a certain path, oftentimes it's like, well, we're going to sell it. And before they really know what their investors want, and if the person who raises their hand first says, yes, let's take the sale and get the hell out of here, and then the deal doesn't happen, that's an awkward situation, probably not great for maximizing value for everyone as well, particularly that member of management who may find themselves on the outside very quickly. So I would say one of the key strategies is, remember your board, so I'm going to speaking to the C-suite right now. Your board, although they're there for governance, they're also your sounding board and your resources. So I would be very, very upfront about, tell me what to do, right? One is a board, right? Because the board has a they as a body, as an organization, have fiduciary duties to the company and its shareholders. And so, you can have a deliberative process amongst your board about what they should do for the shareholders at large, and you want to hear from them. And then I think you have to have one-off conversations with those individual, key investors, right? And really understand, one of the things that I see a lot sitting in the UK is we've had a lot of money come from the US and a lot of money come from Europe, and there's different investment strategies historically, geographically, and having them on the same cap table is often quite interesting because you see an outcome where somebody's swinging for an IPO. And, meanwhile, we've got, investors are like, we'd like to make the nice tidy, like, let's sell it at, $100 million and get out kind of, and understanding, what those folks want. I think it's a big deal. And so, but at the same time, you got to be a little bit poker faced yourself as the manager on that one there. I would be very direct about asking. Don't be shy about it. You're not going to offend anyone. I think just ask, what's your investment strategy? What are you looking to do? If they come back and say, I want that $100 million exit, meanwhile, the founder is thinking about, I could IPO this thing for a couple $2 billion. That's fine. You just got to now got a plan for, do I need to get them some secondary earlier on to give them some confidence? So all that's doable, but I think as soon as you tip your hand as the manager, you're in a point of precariousness is how I would describe it. So.
That's excellent. That's excellent. Sally, Florian, anything to add to that? Feel probably the same as far as early conversations, manage expectations.
Yeah, I mean, it sounds simple, right? It's basics. It's align and understand who wants what and communicate. I think a recipe for conflict is if you think you know what everybody else wants, but you misinterpret it, or if you do something that somebody else is not going to be happy with, then you will have unfun conversations.
Yeah, let's avoid as many unfun conversations as possible. Mission for today, for sure, leaving with that tip. And it's a wise one. So you've given some really good tips and strategies today on like where people can be investing their time on the plumbing, right, on the electrical, on all the foundational elements that can trip a deal up, or looking at the how to mitigate some of the risks of vulnerabilities on like existing customers or vendors or supply chain types of things. Are there any other elements that you'd encourage management as they start to go through this process to invest time on or to think through before going too far down the roads of negotiations? Anything else that you've seen has had good payoffs when people have slowed down to invest on sort of that type of work?
Sally,
yeah, I'll start. I think one of the things that, again, I think we have a group here that's very entrepreneurial and have great ideas, but you have to be able to articulate that in what your core business is. And I think some of the danger in startup environment is growing and expanding too quickly, too fast, without the infrastructure or story or maybe necessarily kind of aligned vision in place. And I think that can come across when investors are looking at it saying, okay, you have all these different revenue streams. How are you going to focus your resources? You have a limited number of resources. How are you going to focus that? And how is that going to cause it to grow? Because I think there's going to be a lot of questions around, well, if you're building or developing a multiple on EBITDA, right? Like, which revenue stream are you going to tag to? And can you articulate what your key performance metrics are for each one? And if not, maybe it's time to divest, some of what your non-core business is. So what really understanding what your selling point is, where the value in your business is, and doubling down on that and making sure that anytime you get asked a question about your metrics, your forecast, your actual tangible cash flow around it, that you can articulate that.
I think that's, I would go actually a step further on Sally on that one there, or maybe not a step further, but adding some detail on that, which I think is great advice. Also be in a position that you're able to do that explanation as if you were a public company, whether you're selling or IPOing. there is a big difference between a young CFO that has not been through a process before and a seasoned public company CFO, right? That's not a knock on them, but like the level of polished speed execution, it's like the difference between being in a college stage quarterback versus an NFL quarterback. It's a whole different level of speed and execution. You should be striving for that NFL level execution. Even if you can't do it, you got to strive for it there because it's going to be expected of you. If you are exiting to a buyer, it's somebody that's looking at you to probably be part of a public organization or at some point, or alternatively, it's a private equity buyer that is going to say maybe that we need to be ready for that, right? Alternatively, you're going to be talking to investors on the public stage, and they're going to be used to a certain level of execution, and they do not take the, well, it's just a startup as an excuse for why it didn't come off crisply. So I think Sally's exactly right on that, which is it's more than just the plucky entrepreneur thing. I mean, you got, some people will have this is an amazing product and, we're not going to turn it down no matter what, but it's that world was 20 years ago. I think that we're in an environment now where you've got to package it as much as you've got to have a great idea and a great business.
Well, that's a great segue to the last question that had come in that I think is such an important one when we think about planning, or at least doing what you can with what you have around you and optimizing for it. What other skill sets would you encourage founders to really be leaning into as they go through their plans for, be it an acquisition or be it an IPO? Are there skills or advisors or types of experts that they really should be reaching out to sooner rather than later?
I'll give the high level answer. My high level answer would be, and again, it might sound simple, but don't try to do it all yourself, right? Get experts around it. So really rely on your executive team. And there are different phases in the growth of your organization where you might have the perfect CXO for a while, and as you're growing, maybe that skill set is not the right anymore. So really make sure that you understand your management team and your spot in the management team. I think a lot of founders maybe think they have to take it from it started in my garage to now I'm a bazillion-dollar business. And the honest answer might be you are good for that first piece, and then at some point there could be somebody else who can help you better. So surround yourself with people who can really drive this business with you and for you.
Yeah, and to tack on to that, I think it's some of understanding what needs to be hired in-house versus what is something good for an advisor. So I think Michael had touched on this briefly earlier as well, which is, hey, you don't need to have everybody in your C-suite or everybody in your management to have public company experience. At least one person should, and be able to at least raise the flags to like, hey, I've seen this at a previous company. Should we consider it? At least bring that to the table. But for example, in transactional things, I mean, it's not, unless you become a serial acquirer, it's not going to happen every day. So you don't need to hire somebody just specifically for M&A in-house. That's something where it might be good for a transaction advisor. However, if on the flip side, it's like, hey, I don't have somebody who can do my financial reporting close every month or every quarter, that's something that's going to be recurring and maybe not the best spend of your money to have an advisor come in and do it for you because it's going to be expensive. Maybe that's something worth hiring in-house. So going through the things that you need and kind of the different where you see yourself in a year, where you see yourself in 5 years, making sure you understand where the cost benefit is to hiring in-house, hiring your skill set in-house versus bringing in advisors. And don't be afraid of that G&A. It's a one-time cost sometimes when you bring in advisors, and this is definitely very self-serving, but we do this all the time, every day. And so there's efficiencies to be gained. It'll be faster. Maybe for a shorter period of time, it will incur G&A costs, but it'll be faster and more efficient to do that, outsource that.
Such great insights. Yeah, sorry, Mike, go ahead.
No, and I don't want to hold us up time, but I would also emphasize a trusted relationship with all those people. I think is huge, right? I think what Sally and Florian got it was use the people around you. You don't have to buy it. You don't have to hire it necessarily, But I think if it's somebody that you can actually talk to is a big deal and all that there. They're not always, and it's okay for them to make sure they're not yes men or yes women or whatever. It's like that. You want people to tell you don't do that from time to time. So.
What a perfect note to end on. Trusted relationships. You have all been trusted sources of excellence and expertise today. We're really grateful for your time and for your thoughtfulness and counsel. It's really been an incredible session. And I know everyone here today has been already commenting on how grateful they are for these insights. So thank you. On that note, if anyone would like to be able to go deeper with any of our experts today, you can do that directly. You can actually book a session. So you'll see that link pop in the chat in just a minute. Feel free to reach out and let us know if you do need to connect with anyone here today, and we'll do our best to make that happen. But for now, if you're like me, you probably would appreciate a coffee refill. So let's go get one. And then we're going to come back in just a couple of minutes with a really exciting panel coming up. So stay tuned for more and take a break, and we'll see you in 5. Thank you. Well, hello and welcome back, everyone, or welcome to those who are joining. We have a great topic coming up on really getting ready on how to execute your IPO. As a friendly reminder, we are open for live Q&A today. So please make sure as we go through the session, pop those questions in that Q&A function that you'll see at the bottom of your screen. As you get ready to settle back in, we would love to get an idea as to where you are perhaps in the timing process of getting ready for an IPO. So I'm going to launch a poll really quickly, and it's simply asking you for this. In the next 12 to 18 months, are you planning on starting the IPO process? I got a few options here. We're either headed in that direction, yes, but probably not in that time frame, or not quite yet. That'll just give our panelists today a little bit of sense as to how to ground the insights, the perspectives, and the recommendations as we go through here. Not quite yet, definitely seems to be a little bit where we're heading. We got about 65% of our audience on that side, 27% though that are planning in that timeline, and 7% that are not quite sure of that. So I'm going to end the poll, share the results with everyone, get to know that you're not alone, no matter which of those environments you're headed for. And let's get started. We have an incredible panel. Our moderator for today is Jack. He is the head of U.S. new listings at NASDAQ. We have Steve Parrish joining us as co-head of ICR Capital, Priya Huskins, insurance advisor at Woodruff Sawyer, Erica Whitmore joining us as audit partner and Boulder office leader at KPMG, and Leanna Whittleton, partner at Wilson Sonsini. Thank you all so much for joining, and excited for the conversation. Jack, over to you.
Thank you, Nicola. Appreciate it. And it's great to see you all and great to be here. As Nicola mentioned, just as a brief introduction, my name is Jack Castle, and in my role at NASDAQ, I oversee our global IPO business. So while things have been slow this year regarding new issuance, there have been 65 IPOs in the US as we sit here today, including a few biotechs and corporate spends. And I'd be remiss if I didn't share that 90% of those deals have listed on NASDAQ. We do feel that there is light at the end of the tunnel, hoping that that's daylight, not the train coming back towards us. But it does feel like we're seeing some of the variables start to settle, such as the Fed starting to end its hiking cycle, as well as kind of stabilization in the equity prices, and really this notion that a soft landing is achievable. Many companies, including those probably like in the audience and tuning in today, as well as their respective boards, are still in the process of this new normal. And what are the expectations of readiness and being a successful public company, as well as being a successful private company. And so we're very fortunate to hear from really firsthand from our panelists today, very experienced advisors, from their stories and perspectives around readiness, as well as executing an IPO or a specific exit. So to kick things off, we're going to go with a round robin of introductions, and then we'll jump right into the questions. So first, Erica, why don't you start for us?
Can you hear me okay, Jack?
Gotcha. Yes, thank you.
All right, great. Erica Whitmore, so excited to be here. And even though there are not a lot of IPOs going on right now, super excited to talk about it because I think it's coming. Jack, I'm with you. So I have been with KPMG, I lose track, 23 or 24 years. And in that time, worked on a lot of different IPOs, It's something I'm very passionate about, is working with high growth companies that are either looking to go public, and then all the way up through, I work with small public companies as well after they go public. And then I hand them off once they get too big to do it all over again. So very happy to be here. This is a great panel of folks. And I also truly enjoyed the last panel. I think there'll be some common threads there. So again, happy to be here. Thanks, Jack.
Absolutely. And Leanna?
Great to meet everybody here, and so happy to have you join us. I'm a partner at Wilson Sonsini. My focus is late stage private companies, IPOs, and continuing the representation through public company work as well. So you're right, there's definitely been not the offering, pipeline that we'd hope to see, but I do think that means there's a ton of pent up demand. And so we are going to see a lot of companies who've been waiting on the sideline for the market to stabilize. And I think it's not even the market going back up, but just being less volatile, right? And so you being able to bring an offering with a little bit of certainty. So happy to discuss those aspects of the market. I think M&A is definitely a strong alternative. We're seeing a ton of pickup and interest there as well. And there's a couple of questions on that. So looking forward to the discussion.
Right. Thank you. And Priya.
Hello, Priya Huskins here, one of the partners at Woodruff Sawyer. We are a full-service commercial insurance brokerage headquartered in sunny San Francisco, serving clients worldwide. Commercial insurance, including employee benefits. We are the market leader when it comes to D&O insurance for your late-stage private and IPO or direct list. And if you're in business, you need insurance. I would suggest that everybody use the slowdown as the gift of time to get ready for when you're ready to go out.
Well said. And last but certainly not least, Steve.
Thanks, Jack. And to follow Priya's comments, if you're doing an IPO, it's very helpful to have an IPO advisor. And as Jack said, Steve Parrish, I co-lead ICR Capital, which is the equity capital markets advisory group within ICR. ICR is a leading corporate and investor relations communications firm. We at ICR Capital, we advise management teams and financial sponsors on the full range of equity capital markets initiatives, with the focus on IPOs and then subsequent transactions such as follow-on offerings, block trades, other transactions related to SPACs. I've been in the equity capital markets world for my entire career, spent the first few decades at a large bank, and I've been on the advisory side for the last decade. And great to be here and excited to talk about IPOs. And I agree with the other panelists that we're on the verge of getting back to a level of normalcy in the IPO market.
Love the optimism. So let's keep it rolling, see how that weaves through our thoughts here. So Eric and Leanna, I'd like you to both take this initial question, but despite kind of this light at the end of the tunnel or signs of the equity market recovery, the IPO market has remained pretty muted. And it feels like there is a concentration of activity towards the back half of the year and then well into 2024. So a question for you both is, when a company and its board have decided that they plan to IPO in the next 18 months, when is the best time to engage with your respective firms and those services? Erica, I'll go with you first, please.
Sure. I think my answer is probably going to be obvious, but as soon as possible. I do like to encourage companies to start working with a Big Four accounting firm, as soon as possible, right? Even if it's on the horizon, but maybe it's 50-50 M&A versus IPO, et cetera. I do think getting that rigor of the audited financial statements and some of those processes and controls in place earlier rather than later will be accretive to the value, right? Regardless of what you do. And so I would just say as soon as possible.
Yeah, and I can't underscore that enough. I will tell you, it's probably more important if you talk to Erica before you talk to me, to be honest.
Although both important.
Yeah, but what I tend to tell companies is, 18 months is the tagline right now. Everybody's 18 months out, right? But having a longer runway is not a bad thing, right? I think you can bring an offering sooner, but it is stressful. It's more work. You're compacting the same level of activity into a much smaller time frame. So if you've got the flexibility of a longer runway and being able to say, look, I can see down the road where we want to be, that means you can roll things out in a more measured manner. And so I think the key things to focus on is the operational readiness as opposed to the offering specific work streams. right? So get your financing house in order, right? That's where Erica comes in. Figure out like, what is your cadence? Do you need to backfill more positions? Are there holes or gaps before you become a reporting company and realize SOX is a pain and you're not actually ready, you need a third-party consultant, right? I think those are a lot of things you can think about up front. I think focusing on your ERP systems, right? Like your regulatory compliance, like making sure your business runs smoothly. And then as you get closer to the actual offering, then we can layer on the transaction specific portions of this, thinking about your board composition, right? Who do you want to bring on? Are you satisfying your audit committee financial expert? Do you have diversity requirements if you're in California, right? And some of those take longer lead times. You want to find the right directors, but you can also push some of that out. Whereas the operational pieces, the regulatory compliance, that's good practice as a private company as well. And so that you can invest in that earlier and not feel like you're wasting time, right? Or not seeing rewards if in fact that window keeps getting pushed out.
Yeah, and Jack, maybe just one other thing to add. Thank Liana, you're absolutely correct. I also think this is a little known, maybe it's a well-known secret. Sometimes if you get us involved before you actually hire a banker, it's a little bit less expensive. And so, getting those things in order. And again, like Liana said, to have that kind of track record. I have several companies that are looking at 2024 right now, and they're practicing quarters, which is outstanding, right? They're going to be ready to roll once they become effective, right? And they're there'll be some bumps in the road. There always are, but there'll be much less because they've got, the forecasting ability in place. They've got the financial reporting rigor. So anyways, I couldn't agree more. Earlier, the better. And hopefully the markets open up and you're ready to go.
Yeah, well said on both answers there. And Priya, over to you, kind of sticking with that timing theme. When is the right time to start up leveling a pre-IPO company's insurance, and how do you and your team help with this analysis?
Sure. So the easy answer is 12 to 18 months before you go out. But I do want to say, if you are a revenue generating company, there's not a lot to do until you actually have a good amount of revenue. So think 75 to 100 million in revenue. That's when there's enough going on and there's enough in your premium that strategic things can and should be done. Obviously, if you're a life science company, it's a completely different metric. Go back to the 12 to 18 months before you go out. On the D&O insurance side of the house, and we do know that new public companies are more likely to be sued than mature public companies. So this becomes important, and it can be either well handled or a total distraction. But so on the D&O insurance side, ideally, I have at least one renewal cycle before you're gearing up to go public. Why? Because in addition to all of the investors who are super interested in your rocket ship to the moon, there are D&O insurance carriers that want to hear a little bit more about your plans for focus, stability, and forecasting, right? So a little less intergalactic domination, a little bit more, we've got this, we're actually running a stable business. And so I want time to prepare you for those kinds of meetings, prepare that sort of messaging, and make sure that we've socialized you with the right insurance carriers. So if I can have 12 to 18 months before that, you're going to be in a much better position when it comes to marketing your program to insurance carriers for your IPO.
Right. Very interesting. I hope we're all taking notes on some of those key points. Steve, I do want to kind of address, I highlighted some of the things we're seeing, kind of some impetus towards the light at the end of the tunnel, but I'd love to get your sentiment around the market conditions impacting companies and their decisions to seek liquidity, and then also touch upon timing. When is the best timing also to engage ICR or broadly advisory?
Sure. Maybe I'll start on the second part first. Similar to the previous panelists, the ideal time to engage ICR and as you're proceeding towards an IPO is ideally 6 to 12 months prior to the org meeting, where you're really kicking off the process of drafting the S1. And during that period, we're working with the company to hone their equity story, prepare financial models that will be shared with bankers and subsequently research analysts, working through an RFP on a potential banker selection process, as well as selectively, where appropriate, connecting the company and setting up a schedule of meetings with investors or research analysts from the banks to start to get them acclimated to the story and to the company. So ideally that's happening 6 to 12 months prior to a banker selection process and subsequent org meeting. Jack, in terms of market conditions, the things that over the past 18 months, when we've had a relative stall of the IPO market, notwithstanding that that there have been a number of IPOs, but the things we've been looking for: lower volatility in the market, and the rule of thumb is volatility levels below 20, and they've been in the teens now for quite some time. Strong follow-on activity where already public companies are either raising capital or existing shareholders are seeking liquidity. Stability in interest rate increases. Other positive economic releases, earnings that are meet or exceed expectations, generally speaking, and most of those data points that lead to what should be a normalized level of IPO activity are in the green at this point, which really leads to our optimism that the IPO process will initiate sometime soon for many companies.
I want to underscore really quick Steve's point there, right? Gun jumping tends to be a big issue when some company first starts thinking about an IPO. And if you've got Steve engaged before the org meeting, he can kind of help you troubleshoot on some of those items so you don't kind of start out in a penalty box. There's a lot of ordinary course analysis that goes into what you can put out as you lead up to an IPO. And so if you've got someone like Steve engaged, he can help get you on a cadence of what press releases should you be putting out so it doesn't start to look weird, right? As you get closer to the offering and we have to say, oh gosh, you've actually never done that before. It's product related, but this is the first time. So there's definitely value, even apart from the offering, in terms of kind of setting up your IR team and how you think about what you want to be putting out in the market. Sorry, Jack.
No, Leanna, I think that's a great point. And I just couple that also, from our seat at NASDAQ, we're very fortunate to work with so many incredible companies, many that you all advise. So what we like to do is also leverage those same best practices to pull those forward for companies going through this process as well. So just identifying certain milestones and as well as kind of those go-to-market strategies in a very succinct way and the proper cadence to ensure not only your compliance, but also building that momentum leading up to that special day. So that's well said. As we think of the different ways of going public, and Erica, I'm going to have you start with this one. There's obviously the traditional IPO, there's direct listing, there's via the SPAC and de-SPACs, and we're still seeing SPAC combinations announced really once a day, if not a few times a week. So Erica, for you, what factors and conditions make these different pathways to the public markets more or less appealing for companies from an overall preparedness standpoint? And maybe what are some of the advantages or disadvantages of each?
Yeah, Jack, thank you. And actually, I'm going to refer back to the last panel. I'm sure most folks are on for it, but being a public company is being a public company, right? And regardless of the path that you take, how prepared you are to be a public company, both initially, right, to get to that point, but also one of my old partners used to say is to act like an adult, right? Be a public company and be able to put out those financial results quarterly and know what you should and shouldn't put out to the public and when, through the great advice of the folks on this call, right, is super important. So I would say being prepared across the board, regardless of what method you choose, is what's most important, right? And I think it might have been Michael on the previous panel that basically said, sure, could somebody convince you that you could go quicker one way or another? Potentially, but at the end of the day, you still need to be prepared. And I'll also point back to, I think it was the very first session that talked about the market update, right? Just as venture capitalists, and I think even PE investors now are not just focused on, especially when you're talking about a technology company, the revenue growth, it's also what's your EBITDA growth, right? So now both matter, and those are both going to matter when you go public, right? And so being prepared is going to matter, right? And so making sure that, depending on how sophisticated or complicated your company is, do you need an IPO advisor, right? That can be us as well as a combination of other folks on this call, right? Steve and Liana and Priya, obviously from the insurance perspective, but really, do I need an IPO advisor? Do I have enough, individuals with the right skill sets? And if not, can I get arms and legs and advisors in here to help us get through the IPO while I put those resources in place to continue to operate as a public company, right? Do I need to get an independent director in, on the audit committee, right? What's the timing of that? All these things, right, takes a lot of time and effort. And that's in addition to your day job. You still have to run the company and meet your numbers, right? And so anyways, lots to think about there. And so I think that might not be the answer you're looking for there, Jack, but I think you need to be ready to be a proper public company and have the time to prepare.
No, I couldn't agree more. There's nothing worse than having to have, from our perspective, tough conversations for those that weren't prepared to become a public company. So I think, for sake of our broader ecosystem and this path through the public markets, it's very prudent to ensure that you are ready. So I think that was well said. Leanna, coming over to you for this next one. This panel is about IPO readiness, but we've covered a few of the options of tapping the public markets, but you also mentioned around M&A, and I know we're going to do a subsequent panel on that. But given today's environment and from your seat, what are some of the key priorities that companies should consider regarding M&A transactions or even dual pathing right now?
Yeah, and I think my advice is kind of still largely consistent, right? That operational readiness is still really important. To double click on that in an M&A process, what that really means is diligence, right? Like, do you have an FCPA policy and is everyone following it, right? Are you thinking about export-import, right? Are those the kind of reputational issues that might bubble up in diligence, either for an M&A deal or for an IPO, where there's cleanup, you're backtracking, you're behind the ball, right? And so I really think making sure that you don't have those sorts of skeletons in the closet is the best thing you can do to get ready and maximize optionality for either, right? I think dual track is very common. In the current market, it can be a little bit harder, right? It's hard to dual track when you know that your IPO track is quite a bit further out. But I think the concept, right, why you would do that is still a little bit of the same, right? You're testing the market for interest. You're trying to figure out what your valuation is, right? And a lot of that's tied to who is your management team? How is this business run, right? Is it clean? Is how they can survive in either environment? So a lot of that work, I think, can be repurposed, right? It doesn't become wasted, right? And so going back to the first question, don't draft the business section, right? Don't draft risk factors right now. But if you are looking at your organization, right, and your structures, making sure you've got the right senior officers in the right places and that people are understanding within the organization, right, how you should be running and reporting up internally, that's going to serve you very well on both sides. I think there's a lot of M&A activity right now, and I know we'll cover more of this later today. The valuations are a little bit lower, right, because of the market. And so I think people are seeing an opportunity there. That can be a good thing or a bad thing for a company, right? In a lot of ways, companies don't want to go public in a down market, but frankly, that means you've got room to grow naturally as the market goes up versus a lot of companies who went out at the top and now are just struggling with market comps through no fault of their own, right? So, that teeter-totter can lean both ways. On the M&A front, right, there's just a lot more, I think, interest. Something I think is important for companies to think about is where are your shareholders, right? And where are their heads? And are they committed to waiting it out 2 more years with you? We've definitely seen a lot of companies embark on a financing process that quickly becomes M&A, and they maybe didn't fully gauge or didn't appreciate how ready their investors are to exit. So I do think knowing where those points are before you start a process will help management not suddenly feel like the rug's being pulled out from under them, right? Or that you've got agreement from the key stakeholders on what path it is that you want to be pursuing.
Yeah. All good points. I don't want to eat up some of the talk track for the next panel, but I think those are a lot of good elements of the process to consider. And Priya, then coming over to you, is there a way in which the timing of up-leveling a company's insurance premium ties into dual tracking for a potential M&A exit?
Yeah, absolutely. So let's say you are planning to be an operating company in the public market. So what we've been talking about is operational readiness for that glorious and blessed day, which includes kind of a full suite of insurance risk management. You do not want to be handling cyber issues in the public eye if you hadn't done that earlier. I hope, obviously. If you are dual tracking, I would move forward the D&O insurance part, the act of looking for an M&A partner, the diligence that's involved. Leanna made this point about where are your shareholders, where is their head? Sometimes it's not a unified whole. There can be some disputes, and I can see her nodding vigorously to that point. So before you embark on any kind of M&A, and I do think that anybody who is putting up the shingle of we're going public, maybe unintentionally is always also putting up the shingle of did anybody want to buy us? They may not have meant that, but that's what the buyers think. So you want to move forward getting really solid D&O insurance in place. The thing you want to remember is you will almost never have better protection as an executive team or as independent directors than what you had in place the day before somebody knocked on the door and said, we want to buy you. That's just how it works. So if you even sort of reluctantly, maybe kind of imagine that you might take an M&A offer if it was big enough, then move forward that D&O discussion, disconnect it from the sort of operating company, 100 million, do we have something that we can actually work with? Because this is an issue for you. When you are acquired, the go forward company, I hope, will be making all kind of promises about protecting you if there's litigation post-close. And let's just imagine for a brief moment that maybe those promises were not as solid as you imagined. You want to have your own protection, and that ties always back to what you had before the M&A process started. It's very late to try and get that insurance in place once you've started M&A. Remember, I said sometimes the active M&A leads to litigation. Carriers are reluctant to insure the already burning building, which is why you want to do this process before anybody is trying to buy you.
Well, we're seeing that in California with these fires too.
I knew you were going to say that, Jack. As soon as it came out of my mouth, I was like, "Oh, please don't ask me about California. Please don't ask me."
I don't think we could have it.
And possibly New York with the Canadian fires as well.
I do commercial insurance just to mention it. Okay.
So, Steve, transition a bit to you. One of the critical pieces to making a decision to go public is having an attractive equity story. So the question for you is, what advice do you give companies for developing a public company equity story? And then is that different from the story they tell to raise capital privately?
And Jack, that's a great question and very topical, because things have evolved in the markets and what investors are looking for in equity stories and their focus on companies and the attractiveness of a potential investment. I'd say, a few years ago in the 2021 period, investors were primarily focused on growth, and they wanted to see high, they're willing to pay high multiples for high growth and profitability. If it was postponed or deferred, that was okay. High growth was the priority. And, clearly investor focus now is always going to be on growth. Growth companies are always appealing to investors, but they are focused on is the growth that you're talking about defensible and sustainable, and how does that lead into profitability? That it's been much discussed, but that is a theme that is not just jargon, but really the focus of investors. So creating an equity story that demonstrates growth that is sustainable and realistic, and how that translates into near-term profitability is a key component to an equity story. And obviously every sector, every company is unique and has characteristics need focusing on. Everybody likes to hear about moats and other distinguishing characteristics.
Yeah, I think that's great feedback. And I think it certainly pairs with what we're seeing in the market as well. And I think you nailed it around the moat, like just really having tangible evidence of that total addressable market or that TAM or the experience of your management team, setting forth this new plan, but really being able to provide conviction that you are going to be able to execute not only in the near term through the IPO itself, but for the subsequent few quarters, right?
Yeah. And Jack, to your question on, is there the differential between, having an equity story for a private capital raise versus a public capital raise? There's certainly tweaks that occur, but by and large, private market investors, often think about an investment in a private company. What's the exit and how is this story going to resonate with ultimately public investors? So having an equity story for the private market that is going to, mirror what the story is going to be for the public market gives the private investors confidence on how the company is going to progress in its financing and other strategies.
Yeah, that's a great point, Steve. And I should probably caveat that it also, for each company, you nailed it on, it depends on the sectors, but it also depends on the growth stage they're at, right? So the Series B fundraising is going to be very different, as much as some of those elements will weave into that story, but it's going to be much more growth oriented, product fit versus the later stage, as you're sharing. And I think is more relevant for your description there is a bit more of how we've already grown up and will continue to execute as a public ready company.
Absolutely.
Yeah. So Erica, then thrown over to you, when does a company know it's the right time to go public? Are there key internal or external milestones, customers, suppliers, predictability that you feel trigger the decision?
Yeah, no, great question. And I actually going back to the equity story, right? Like if we kind of parcel out, right, like the growth engine's working, right? We're generating positive EBITDA. I do think, the industry, right, matters quite a bit. But as far as like internal and external systems, there's this quote, and actually it was mentioned in the last session. So I did think that was a great session. That's why I keep referencing it. But nobody cares about the financial statements until it's holding up a deal, right? And so again, just one piece of, the IPO readiness process, right? But such a key piece. And Leanna mentioned earlier skeletons in the closet, and I think she was referencing more from a legal and a contract perspective, right? But you don't want skeletons in the closet with your accounting because those aren't fun either, especially, they can and will hold up a deal. It takes time to get through those things. So, in terms of systems, you can go public on a system like QuickBooks, and many companies have. I think it depends on how complicated you are, right? And the type of resources that you have to put together, again, that quarterly reporting package and be ready to present those financial statements quarterly. I've also seen, and again, I think it depends a little bit on the market. I think right now things need to be a little bit more mature. And Jack, I'd love your view on this too, right? Whereas maybe in the height of all the technology companies going public on, really awesome revenue multiples, right? Maybe you had plans in place to get those systems to where they needed to be. And again, maybe today those you have time to mature those processes, right? Maybe you put those systems in place before you go public. Again, you can do it either way. It's just the level of complexity and how smooth the IPO process is. A couple of the things I wanted to mention is in terms of your suppliers as well as your customers. I do think it's important. You don't want to go public if you've only got a handful of very significant either customers or suppliers, right? Because if anything happens to them, that could significantly impact your business and your ability to forecast and cause a pivot that the public may not view as favorable, right? And so I do think really understanding that and where does that fit and talking to the bankers and people like Steve to understand, how does that fit with your story and really your readiness to go public are really important things. And then one last thing, and sorry, Jack, this got a little longer than I meant, but I do think ESG, right, is super important. And while maybe not, there's not necessarily any clear guidance from the SEC yet as to what does that mean and how do you do that, I do think, especially if you're an international company, you've got to have a focus on it, right? Even if you're not an international company, your customers and your suppliers are probably, if they haven't already, going to start asking, what diversity and inclusion types of programs do you have in place? What, do you track your impact on the environment? Do you have a plan? Anyways, just a real high level hit there. But I do think ESG is coming and it's only going to get more and more important. So long-winded answer, sorry, Jack, but yeah.
No, you hit a lot. So I appreciate it, Erica. And I think, I am going to maybe just follow up on the ESG question there, because again, from where we sit, we're seeing a lot of momentum there. We have an advisory service and some software there as well at NASDAQ to support our listed companies. So Priya, I'm actually going to come to you with this next one, because we are, as we're all seeing, this growing effort around ESG focused initiatives for companies, both private and public. But many of the pre-IPO companies do not have a large budget for all the facets that is ESG. How do you think pre-IPO companies should think about this?
I serve on several public company boards. Nobody has the budget for the kind of aspirational disclosure that I think the SEC is currently contemplating, and yet here we are. What I would say for private companies is absolutely going to be a question, and Erica is so right. Whether it's a regulator or a customer, you need an answer. And over here in insurance risk management world, please make the answer consistent across modalities and people you're talking to, and maybe your website also. So I would start for private companies, and we'll keep this short because this could be an entire day. Authenticity. You cannot be all things to all people, and nobody expects a new public company to have the kind of high level, incredibly sophisticated disclosure that the most mature public companies have been working on developing for years. So whether it's one of the three pillars or some of the three pillars, figure out what's authentic and then put some effort into that, recognizing that in a lot of ways you should ride the path that is being a new public company. So don't put out every single thing you've ever thought of. And also, don't we do that bake sale for the kids? Don't do that. Have a strategy, however small and thin, and then do about half of that, knowing that you're going to have to improve it over time. Now, my asterisk is what I said where I started. The SEC is very serious. They just released their latest agenda, rulemaking agenda. It looks like we're not going to get climate and cyber final rules until October, but we will get rules. And so everything I'm saying is caveated with the SEC is continuing to threaten us with real rules. You're going to have to comply with them. But remember, it's always a disclosure accuracy regime. So just one more time, it's got to be consistent across all of your different channels. And you need to be able to back up what you're saying.
Well said. And Steve or Leanna, I don't know if you have anything to add on from your perspective on this topic of ESG.
Leanna, defer to you.
Yeah, I do want to just emphasize what Priya said. It's a disclosure regime, right? So this is the what are you doing? It's not a make something up that sounds great, that is aspirational. It's really where are we today, right? And I do think there's a lot of hot button issues around that, right? That can be employee engagement, right? That can be, do you have a cycling program on site? Do you have an office, right? Or are you guys fully remote? So there's a lot of different ways to unpack that. I think there's just a lot of political spin around it, but at its core, right? When you're talking about any kind of offering, it is really, what are you actually doing, right? What is the substantive focus of your company, right? And I think a lot of that is, we'll have companies say, okay, here's the aspirational goals that our IR team put together. We say, okay, who reports under that? Oh, it's under legal. Okay, my guess is if it's under legal, right, like it's not substantively that same aspirational goal. It's more of what are the main requirements, right? So also think about not just the positioning, right, but pretty saying being consistent across channels, right? Like what is actually achievable here? I do think that is very important.
Yeah, and I would say, just from the, communicating the equity story, it's imperative that you include, as Leanna said, references to what you're actually doing and how you're addressing ESG and how that's part of the corporate strategy and corporate framework. That it is an essential part of communicating to investors.
Yeah, and I think I just add on to that. I think everybody had a great perspective there, and I think the key is for companies going through it, and it will vary by sector and geography, but you want to make yourself investable to the broadest set of investors, right? And so, to your point, we don't want to. You want to avoid greenwashing and kind of that trap. So you want to have a credible story, but by creating an ESG framework and having that in place with buy-in from your management team and board, it helps you to create that credible story, and you're all on the same page as you get to market. So I thought well said and good perspective across from all of you. So thank you. Thanks, Erica, for jumping to the ESG. Steve, I'm going to come back to you. Just around, you mentioned how ICR engages with companies and helping them to identify some of the public investors as well as analysts. And so we've seen a trend of companies starting that element of the process much earlier as well, sometimes 12, 18 months ahead of the IPO. Do you recommend a minimum or maximum numbers or a specific cadence for companies with these? And what should they be thinking about regarding the best practices when meeting with investors?
Yeah, that's a great question. And that's been a dramatic change in the IPO process, really as a result or at least accelerated by the pandemic. Prior to COVID, companies didn't engage with investors on Zoom calls. It didn't happen. Maybe, occasionally there was a video conference call, but it wasn't a regular way, normal operating procedure. Because of the, unfortunate situation that we all found ourselves in, the world changed and companies started meeting with investors. And of course, stating the obvious, found it a very effective and impactful way of developing relationships and meeting with investors. And that has caused a proliferation of companies meeting with investors and analysts prior to the IPO process. And where it was less common for companies to meet any public market investors before the IPO process, it's now almost a fixture and a certainty. And those meetings, however, to Jack's questions, it's important to think strategically about them, because you're at a preliminary stage. You haven't yet created an S1. So we work with companies on, highlighting the key attributes of the company, getting to know the investors, educating them on the company and competitive advantages and the key dynamics, but, deferring deep discussion of financials and other things that are going to be carefully thought about as you approach, with the teams at our other panelists, as you approach the S1 drafting process, disclosure, as you really finalize how you're going to disclose your financials. There's still discussion. Are we going to disclose them in segments, or how are we going to disclose them? So consistency is important. And what you don't want to do is go down a road that you're not going to use, in subsequent. So keeping it general, but investor interactions at early stages, help build relationships, and investors now expect to meet a company multiple times before they're asked to make a decision to participate in an IPO.
Yeah, and I think that's, I think you nailed it with that last point too. That is now the expectation, right? And again, as we've all kind of addressed with this new normal, with the goalposts moving a bit on, what you're looking to show from a financial profile, your growth story, et cetera, by getting ahead of that and telling your story, and also likely getting the feedback from the street, right? From investors, from analysts, is that story resonating? What part of this is not? Because then, as you continue to bolster that story, as you mentioned before, once you get to, hey, we're launching, we're on file, we're flipping, we're going, you're looking for those long onlys, those anchor investors that are going to be there. And those are going to only be those firms and investors that understand or bullish on your story. If you're starting that conversation late in the game, you're doing yourself, your investors, your company a disservice, because the probability of them sticking around for several subsequent quarters is likely pretty de minimis. So Steve, that's really good insight there. And I do want to, Priya and Leanna, I'm going to throw this one to you both. But we've seen several recent cases of companies lacking proper, really corporate governance. And so, Priya, I'm going to start with you just to share your perspective on the need for corporate governance and when executives should start thinking about a public-ready board.
Yeah. I'm going to get a t-shirt made that says governance doesn't matter until it's the only thing that matters. And it's just sounds like a tautology, but it's completely true. So the thing I would say about governance as a general matter is, first of all, in my world, think of it as the fire sprinklers of risk, and of D&O risk in particular. And so Leanna and Erica, as they're up-leveling companies, they're asking you to do a lot of things that for founders often feel like a bureaucratic nonsense. And that is sometimes because the founders are not appreciating that Leanna and Erica are getting folks ready. They're installing the fire sprinklers for what happens in the fire of, the public scrutiny. So I need to stop talking about fires, Jack. I blame you. So as a first level thing, if you think of it, if people can switch from this is bureaucratic and why do we have to do it to maybe a sense of curiosity, I bet there's a reason we have to do it. That can actually be really helpful. I was a corporate securities attorney, and now as a former one, nobody is more enthusiastic than I am about those policies and procedures that exist in the management environment that frankly make litigation less likely, or if it happens, goes away faster and for less money. And that actually gets me to the board part of it. You do want to recruit appropriate board members. And what I mean by that is board members that have helped other companies scale. Maybe you're going to have ultimately one or two very big company board members because of their industry expertise. But the worst thing you can do is have a board that is too muscular for the stage where you are. So thinking in terms of that one or two keystone, the audit committee kind of people at the beginning who have done this a couple times really helps companies and often founders hear the governance message better. It doesn't have to be the catastrophe that is FTX or Theranos for it to be important. There are a lot of companies that every advisor on this call has seen who didn't end up going out or went out and immediately stumbled because they didn't pregame the governance appropriately.
Leanna.
I think Priya said it all.
Yeah.
One thing, and I'll put on my kind of pointy lawyer hat here, right? The processes, that bureaucratic sort of crap, if you will, that we impose on you, the reason for that is in the aftermath to show that there was a process, right? You also need to follow it, but fundamentally, what you're often on your back foot on when defending against these is, did you ask the question? Or why didn't you? Or why didn't you do X, Y, or Z? And so a lot of what we are trying to do is say that process is actually what ends up saving you, if you will, by showing that there was fair and full discussion, that there were parties that were informed. And that can be both at the board level, but even internally, right? I mean, as part of the IPO diligence process, we often say, okay, are you sure your sales team is not cutting side deals with folks, right? And everyone says, yep, definitely sure. We say, okay, ask them to certify that. And then we go, oh, they don't want to sign that, actually, right? And so kind of fleshing some of that. And you only know about that because there was a process to kind of chase it, right? And so the process is not meant to slow things down just for the sake of slowing it down, but it really is making sure that the right people are having visibility within the organization, because you're going to be accountable for it, whether you know about it or not. And so it's better, right, that you are aware of it so you can assess the risk. And as a small company, you're being fast, you're being nimble, right? Your sort of willingness to accept risk is greater, right? And as you get closer to either an M&A or an IPO, the scrutiny increases such that some of those judgment calls are going to change, right? That risk assessment is going to change. And the corporate governance process is meant to help you institute a framework to identify that before someone else does, right? I mean, I totally agree with you. Like FTX is, the red child of just absolute, failure, but there's a lot between here and there, right? And those are the things that you want to be thinking about as you're moving forward here.
Yeah. Both great answers. And Erica, coming to you as part of governance, there's obviously a key focus on risk management, and we're seeing technology continuing to play a key role in risk management, including SOX compliance. With that, I presume there's still a large number of companies that have yet to adopt technology in this area. So can you take maybe a minute or two to just describe the overall landscape and what you see from a technology adoption here?
Yeah, no, absolutely. Kind of all across the board, right? We have some companies that, have maybe a couple things in their close process that's automated, but the vast majority of their key controls, right, are still manual. I think that maybe technology companies are maybe a little bit ahead of the curve. At some level, you can get too many applications, right? Maybe they don't all talk to each other, and that's a different risk. So I think it's, there's a lot of room. There's a lot of companies out there that are heading in the right direction. I would say the quicker you can put those things in place, the better. Again, keeping all things in perspective, not getting too many applications that don't talk to each other, don't work with each other, or they work for this department, maybe the sales department, but then, the accounting department doesn't know. Anyway, so long way of saying heading in the right direction, but the more things are automated, the less room there is for manual errors, right? So.
Well said. Leanna, we're coming up on time, and thank you for your questions in the Q&A field. If we haven't addressed them, we will get to them in the last block of time here. But Leanna, I did have one more question for you. The SEC is considering a new Reg D requirement for increased transparency for private companies. So just want to get your opinion on what impact you think this would have on some of the larger companies or the unicorns and their ability or decision to remain private longer.
It's a great question. And so I was at the SecReg panel where Commissioner Crenshaw outlined that. And there was a fair amount of pearl clutching among the private company lawyers in the room saying, what? Pre-filing? What? Make that public? And I understand where the SEC's concern is. In some ways, I think it misses the mark a little bit in terms of practically how these deals tend to get done, right? And at its core, what they're struggling with is it's not the big investors who need protection, right? They are getting all the diligence. They're getting all the financials, right? They will run diligence and they will have all that information. It does tend to be your smaller follow-on investors who are told, hey, so-and-so's lead, trust them, right? So-and-so has counsel, trust them. And so we're not going to give you all the same information. And so that's who I think the SEC is trying to protect, right? It's not your big PE funds and VCs that need a Form D, right? Like it's information they already have. It's not going to be helpful to them. But I do see this concern about the sophistication of these sort of others, right? Now, others, follow-ons, right, can be other sophisticated VCs who really don't need that level of information either, right? And there's a fair amount of information sharing, right? If I'm lead counsel for an investor, I often share my diligence memo with the other investors in the round. And so I see what the SEC is struggling with. I think the Reg D revisions are kind of a blunt instrument to solve for it. And I'm not sure that doing that is going to push unicorns into the public markets instead, right? I mean, I think the reason that companies are staying longer is because the amount they can raise as private companies is greater now than it was before, which is enabled by the size of some of the funds, right? And so in some ways, I see their concern, but I'm not sure it's going to blunt what other sort of economic drivers there are to how companies are doing their fundraising. My guess is we do end up with enhanced disclosure overall. Like I think now the SEC has made that public and said, look, we're looking at it. I do expect there to be an increase. And the question will be how much, right? I think disclosing basic information about the company's size is probably not objectionable. I think disclosing financial information will create a lot of heartburn, right? I mean, I think companies aren't ready under 701 to disclose that to their employees, right? Like often they're struggling a little bit with their investor base, right, who want quarterlies. And frankly, to Erica's first point, right, they don't always have a finance team that even can report on the cadence, right, that the information, requirements are that are in an IRA, for example. So it's something that definitely a lot of us are watching. I do expect that there will be changes eventually. And I think the balance here is how much of a deterrent effect you have to fundraising, right? Versus a disclosure benefit that you have to some of those smaller investors. But it's definitely an interesting development. And all of us were in the room turning each other like, oh no, what does this mean? And what does it look like? And so I don't think it's going to end up pushing more companies into the public markets. Like I think the reporting obligations of being a public company are still quite significant, right? From a cost perspective as well as time. And so companies are going to stay private as long as those avenues of funding are available, right? And the question is sort of what is the cost vis-a-vis public disclosure to stay there?
Yeah. Great perspective and interesting to see how this and several of the SEC's initiatives unpack and evolve over the next few months and quarters. So appreciate that. Before jumping into Q&A, I do want to just conclude this session or segment of our session with just words of advice for the audience. So Steve, I might start with you on this one and just what would you say? What are some words of advice for those thinking about IPO readiness?
Well, I think it's been much discussed on, over the past hour, being prepared. There's no substitute. Failure to prepare is preparing to fail, as we say. And there's, it's not too early to start to think. The IPO process, we find people are surprised. It's a lot more complicated and consuming than people imagine. And starting early and educating yourself and working with all the different groups and being as smart as possible about the process as soon as possible is sort of a key piece of advice.
Yeah. And Priya?
Get ready for the process physically. Hydrate, stretch it out. I'm not kidding. I have had conversations with people who sounded drunk and were just sleep deprived. They're not making good decisions. So as you think about the process, recall that there is a day job going on. You need enough resourcing. Rely on advisors like us and others to help guide you through it. And pick up the wins that you can early. So every panelist, including myself, we've all discussed things that you can do early to prepare. You will not have more time the closer you get to the big day. And so pick up those early wins. Be planful, get it done. Do the blocking and tackling, including insurance that we've talked about.
Thank you. Leanna?
Yeah, so I think early prep is not a bad thing, right? I think there's a lot of companies who had expectations of an IPO in 22, right? And those sort of expectations have been dashed. But unless you were running out of money, right? And often an IPO it's a branding event, it's a milestone for a company. And so the more time you have to work towards that to smoothly execute, the better, right? In my view. And I think all of us around here have seen the quick and dirty, the get it done. We have a window, right? And it can be done, but it is more painful, right? I mean, Priya's right. Like sleep is in short supply, right? The closer you inch through this. And so the more that you're able to front load, like certainly the better, right? I think that's accretive to companies. And so while it might be frustrating in terms of you had a goal and an expectation, it definitely doesn't hurt from a practical sort of implementation perspective.
Thank you. And Erica?
I think you've heard it, right? Being prepared. And I would also just add to that, just having the right people on the bus, right? So who you have on the bus with you, make sure they're in it and you can have the real honest conversations. That's very, very important.
All right. Well, thank you all for that. We have a few minutes left, so let me just grab, and this light keeps coming off in my room, sorry. Hey, Michael, we're going to have you turn off video. Yeah, perfect. So one question from the audience that came in, and Steve, I might direct this to you first, but also Leanna, you had mentioned it in one of your answers as well, but we've seen valuations change quickly over the last few quarters. How should private companies think about valuations as it relates to the timing of an exit?
Well, if we're focused on IPO valuations are clearly a function of public market valuations. And that's, part of the reason for the real slowdown in the IPO market is it takes time for companies, financial investors to recalibrate towards the current market valuations. So the current market valuations are going to be a driver, and the IPO valuations are going to be derived from those public market valuations. And clearly in certain sectors, there's been a dramatic change in multiples from 2 years ago. Ironically, we looked at, and I know we got to move on. We looked at tech valuations, and tech multiples are basically back where they were in 2017 and 2018. So they're much more consistent with a normalized trend line, but they had, risen so high. So the key word is recalibration in thinking about valuations to the market.
Yeah, and the market is a double-edged sword, right? I mean, when the market is up, you start up, right? But if the market comes down, you will suffer from that decrease not related to you. So I agree, it can be frustrating to go out at a lower valuation than you'd like. You end up taking more dilution from the offering. But what that does mean, right, is that you've got this sort of greater runway to then execute, because then as the market comes back up and comes out of this, you will naturally rise and see the benefit of that. I mean, I think we've all seen a number of companies that went out. I'm going to pick on SPACs, but it's been a number of companies, period, right, who went out when the valuations were high and are getting just hammered, right? And your stock price is dropping below $1, not necessarily through any fault of your own, right? But that's where the market is. And now you're looking at stock splits and other things to try and address that, right? And so I think not having that automatic macro downward pressure can be a good thing. But, I know it hurts when you're looking at what is that 10% for this offering and how much more of the company you feel like you're giving up at that time.
Yeah, but one just quick comment on that. To Leanna's point, what companies that do elect at, call it recalibrated valuations, that do elect to go forward, they do the analysis of, well, we're selling 10 to 25% of the company to the public. We're still going to own 70, 80% of the company. So the incremental dilution from a few multiple points lower in selling, 13% of the company is insignificant versus how Leanna talked about the opportunity for appreciation as the market recovers and valuations and multiples increase.
Yeah, that's well said. And I think another element, Leanna, you mentioned this before, but we've all lived through it. The IPO is a moment in time, right? And we're seeing this through private rounds as well, an allergic reaction to that down round, whether it be the private round or out to the IPO, as everybody kind of, again, gets used to this new normal. But the inverse of that is waiting perhaps too long for that perfect moment or for this rebound, or doing a deal with a lot of structure around it, because as we know too, that structure ends up staying with you throughout the life of the company. So as we talk about exits and you look to a private round, a public round, a secondary, an M&A, structure is going to sit on top of that versus a down round, which again is a moment in time based on some of the variables that can be outside of your control, but you can continue to grow into that. And as Steve referenced as well, we are seeing an uptick in secondary offerings. So a lot of those initial IPOs and primary offerings have been, maybe it's not the 15 to 20%, but more in the 7 to 15, 7 to 10%. But with that follow on, maybe 6 to 12 months later, to continue to capitalize the business as they get their story out and have a few more quarters under their belt. With that, we are at time, just right on time, Nicola. So I just want to sincerely thank each one of you, Steve, Erica, Leanna, and Priya, on spending the time with us today to share your knowledge and expertise with our audience. I learned a lot. Anytime I was looking down, I was scribbling some notes. So hopefully the audience found it as educational as I did. And please reach out to each of them via LinkedIn or email, because they would be happy to answer your questions. And I can't speak highly enough of every one of them and the services they provide. So thank you all. And Nicola, over to you.
Thank you, Jack. Thank you to each of you. Really, I couldn't echo better sentiments than how Jack wrapped that up. We learned a lot about recalibrating valuations, managing expectations, taking care of ourselves, pacing ourselves, and using this time to get on the bus well. And on that note, if you would like to get on the bus and find these incredible experts and advisors in support of you, there's a link that you can actually use in the chat today to identify if you'd like to get some extra one-on-one time with them. We encourage you to do just that. And we also encourage you to take a moment to stretch. It's been a long session, I know, and we've got one more great one coming up on M&A readiness. So let's take a few minutes, get that coffee refill, and we'll see you back here in just a couple. Thanks so much. Hello and welcome back to our Exit Optionality Bootcamp. We know this market has been a challenging one, and I hope you've been as inspired as we have today in hearing from our experts on how to navigate it as successfully as possible and gain greater optionality through it all. And we're not done yet. We've got one more amazing panel that we're about to launch here. But before we do, just a friendly reminder, if you need to connect with any of our experts today, you can do that by connecting in that live chat that you'll see down below. Identify which experts you'd like to talk with, and we'll make sure that that happens for you after the sessions today. Second of all, this is engaging and meant to be for you, by you, with you. So if you've got questions that you need to ask our experts, make sure you use that Q&A function that you're going to see down below. Now, if you haven't already figured it out, we do love a good poll at the center, and I've got one more that I'm going to launch for you here. And that is just kind of asking you to take a moment to reflect on which side of M&A you're looking to learn about today. As with the other panels, this will help us and our experts today gain a little bit more knowledge on which area to cover, go a little bit deeper on. So thanks for sharing that. I'm seeing obviously a strong sell side representation today. Right now, about 82% of our audience are looking for guidance on that. But we still do have a good buy side representation of about 17% today. So thank you so much for sharing. And now let's get started. First, let me introduce our incredible moderator. She has been one of our earliest advisors at the center and is an incredible board member that I'm so grateful to learn from beside each and every day. Roberta Burrows has also helped Fortune 500 companies successfully navigate their digital transformation, and she's going to be just an incredible expert guide on this conversation as we go forward. She is joined by Michael Russell, partner at Wilson Sonsini, Emily Meyer, partner and senior VP at Woodruff Sawyer, and rounding us out is Kiki Har, general counsel at Sumo Logic. Thank you all so much for your time today. And Roberta, over to you.
Thank you so much, Nicola. Hello, everyone. So happy to be here. Again, as Nicola said, I'm Roberta Burrows, board member, the NASDAQ Entrepreneurial Center. And this is our last panel for today. So let's get to it. Today, we're going to be talking about M&A. And I'd like to address my first question to you, Emily. What is your sense of the M&A market as we approach the midpoint of 2023? Obviously, there's just been a lot that's happening in the market in terms of not only just tech, but we can see that trickle down to other areas of the industry now. People are talking about how good jobs are, but what does that really look like? So what do you think it means for startups considering M&A exits in their near term? What is that looking like from your perspective?
Thank you so much. So, yeah, very interesting. You know, the Fed just didn't hike the rates and put it on a pause, but at the same time said they're expecting perhaps 2 more in the rest of the year. And we saw the stock market respond to that very quickly in the way that the stock market does. And that sort of dropped precipitously on that news, but we had been seeing a tremendous rally. And I say all this because I think M&A exit, you know, is not only selling, but also potentially IPO. And I think when the IPO market is strong and everybody's making money, then the M&A market becomes strong, right? So I think the first half of the year was, you know, as people have talked about before, there's a tremendous amount of recalibration on pricing and a tremendous space between sellers and buyers. I think what we're seeing in terms of deal activity was there has been a slight uptick in the last month. I think people are starting to feel a little bit more settled, and I'm seeing more activity. I'm still, I think there's still a lot of PE waiting to sort of where they feel the bottom is before they start buying. But I think it's going to get more robust, and I think that the fourth quarter might prove interesting.
Okay. That's good. That's also really, I mean, I have to say that that's much more of a positive sentiment than we've been getting since the beginning of the year. So I'm going to turn my next question to you, Mike. Just given the current market conditions, what sort of advice are you giving to clients as they are considering M&A exits and other alternatives as we're moving through this year and into 2024?
Sure. And first of all, I'm not sure I'm as bullish as Emily is. So I'll start by saying that, right? Our view on the market is it's very challenging still. I think the word I hear describe it most is very choppy. We are seeing activity. We're getting the calls. People are talking about doing deals, but we're seeing a lot of starts and stops. Deals are taking longer to get done than they've done in the past, and deals are dying, right? And so there are deals getting done, and the right deals are getting done, but it remains a challenging market. And so in light of that, what I tell my clients is they're looking at these processes, I just tell them to think hard before pursuing an M&A exit, unless they're either fortunate enough to be in demand, right, where they're able to command a valuation that makes sense, or on the flip side, that they don't have another choice, right? They have limited opportunities, limited funding might be available to them, and they feel like we have to do an exit because that's our only option here. The deals we're seeing, again, a lot of them are tough. We're seeing down round mergers, where you're below the last round of valuation. We're seeing distressed asset deals. Those things are not common. Those are hard deals to do. Low return stockholders, risk of stockholder claims. So again, it's a very, very challenging market to do a lot of transactions. Again, some exceptions, but that's a lot of what we're seeing. And so in light of that, I tell my clients, think long and hard before you undertake a process. You may not have a choice, in which case we'll do our best to help you. But if you do have a choice, if you have cash runway, if you feel good about your financing opportunities, unless you have a compelling reason to do it, like an offer comes in and it's like, this makes sense, right? We really want to do this transaction. I really encourage my clients to make sure they think hard about whether or not they want to undertake a process. I think what we see a lot of times, and I know, Kiki, I'm sure you've experienced this and seen this, a lot of times when a deal starts, you may go in and say, well, maybe we're not going to do it, and maybe it's not the best terms, we're not sure. But they tend to take on a life of their own once you start. And that creates a lot of ancillary things, impact on the business, distraction, lots of other issues arise as a result. So again, my advice to clients is, be thoughtful and be conscious about your decision right now. And if it makes sense, let's do it. But otherwise, if you can hold out for a while and there's no real need to do a deal, it might be worth waiting.
Okay. That's good. I mean, definitely like the different perspectives that we're getting here from our panelists. I think this makes it definitely more exciting for our audience. And I'm going to pass this along to you, Kiki, just because we talked about kind of what our experts in the marketplace are seeing right now. But given the fact that you did have the recent sale of your company, Sumo Logic, and after taking it public about 3 years ago or so, what are some of the key differences between the M&A process and the IPO process? And feel free to expand any insight given the conditions that we're in today.
Yeah, so, I think one of the big things is timing. Timing can be very different between an M&A deal and an IPO deal. And as part of that, your planning and preparation, or your ability to plan and prepare for either transaction, is very different. While your actual IPO process is 4 to 6 months, you've likely been planning for months, maybe years before that. You're doing your public company readiness assessments, you're hiring up certain functions like finance or legal. If you were like us, you showed up to your first org meeting with a near fully drafted S1. On the other hand, M&A deals, they can come in out of the wild. Maybe there's a strategic buyer out there that's been following you for a long time, and now they feel is a great time for them to approach you with an offer. And deals move very, very fast. They can move very fast. I've done M&A deals in 6 weeks or less. And And especially just to get to signing of a deal, if you don't have to simultaneously sign and close, just to get to signing can be less than a month. So you're probably going to be very unprepared for the level of scrutiny and diligence that an M&A transaction brings, because it's a significant ratchet up in terms of scrutiny from a financing, and it is also very different from an IPO. So if you've been preparing for an IPO, it can just sort of become a different process. The people you involve in that process also is a big key difference. You're probably likely to have a lot more people involved in your IPO than your M&A transaction. You know, for us in the early stages of our process, the only people that knew what was happening were the board, our CEO, our CFO, and myself. We didn't bring other employees under the tent for quite some time. And even when we did that, it was staged. So your knowledge or the knowledge of that core team of people will often have to be enough. Or you'll have to be creative in the way that you ask questions and get answers from the rest of your team to not set off feelers. That's going to have to do a lot of times in that process, which can be a challenge. I think this also kind of leads into the real difference between the two processes for me is the change management and the cultural expectations that are involved in these. When we talk about exits, we're really talking about a financial exit. We're talking about a liquidity event. For some companies, though, an M&A transaction is an actual exit. You know, and everybody always views IPOs as this, you know, very celebratory moment for people. Whereas alternatively, an M&A deal for a portion of your employees, for some of your other stakeholders, maybe even your customers, it can feel very final, and that can be very stressful for those stakeholders. You know, especially if what you're looking at is a strategic buyer that's coming in with plans to really integrate your products or services into their whole business. You know, your culture may not survive that. Your people may find themselves in a very different position. And I'm not trying to be grim. I mean, I do think that M&A deals are very successful events that should be celebrated, but you have to manage those inevitable feelings of loss and change that can also occur. And that's very different than an IPO.
And that's, I mean, I can say that I've been through a few M&As myself. So it is definitely a different feeling. And I've also been on the other side at a company where we've IPO'd. So the sentiment that you're talking about towards the end is definitely telling. And I want to go back to you, Mike, too, because we talked about just now how those processes are different. And you just mentioned you've been telling your clients and customers, you know, do you want to go through that process? So to go a little deeper, that startups need to focus on when it comes to due diligence, even ahead of like those M&A conversations.
Yeah, Kiki touched on it already. You know, M&A processes are very intense. Yeah, I think a lot of times when I'm on the sell side of a transaction, my clients could be somewhat surprised because they've gone through financing and there are some warranties and there's some scheduling. But you know, Kiki used a good word. You know, it ratchets up tremendously when you're in an M&A, depending on the potential buyer. I've had some very, you know, conservative strategic buyers with giant legal departments, and each person in that legal department is responsible for one sliver of the company. And they're going to turn over every stone because they don't want to be the person that missed something, right? And their job's at stake. So that's one extreme, but still, you know, the diligence process is a very intense, deep process. And if there's significant problems or issues that a buyer finds, right, they may look to reduce the price. They may look to reduce, change the terms somewhat. They may look to shift risk to the stockholders of the company that's being sold. And in the most extreme cases, they may choose to walk away from a transaction. And so it's an intense process, and there's real consequences depending on how the process goes. So how do you navigate that? The first thing that I would advise everybody on this call, even if you're not thinking about doing an M&A process soon, is to try to do things right from the start. And what I mean by that is, you really want to have good corporate hygiene when you're issuing stock and options. You want to make sure you protect your IP. We see issues all the time come up where companies outsource development to, I'll just use an example, in Eastern European developers, because it's a lower cost alternative and it just makes sense. And that's okay. Companies do that, but you want to make sure you do it right. And you want to make sure your document's right. And you want to make sure that you get the rights to the IP. And if you take an off-the-shelf California form you use with your employees, it may not work for, those developers in another country. So that's kind of one example of doing things right from the start. Similarly with your contracts, there can be a lot of pressure just to enter contracts, drive revenue, build the customer base. But, what comes with that is you want to be careful and thoughtful about what's in your contracts, because you may have provisions in your contracts that seem perfectly fine for your company at the time, and getting that win is critical. But when it comes to an M&A process and somebody's actually reading all those words, if there's provisions in that contract that are problematic, they're going to come up and you're going to have to deal with that. And, we recognize the cost constraints on early stage companies, that there's often a reluctance to spend a lot of money on legal. We get it. I understand that that's the reality, but sometimes you just need to spend in those areas and spend the time and energy and get help, because, if you cut a lot of corners up front and you don't do things the right way, it can jeopardize deals. And I've seen that happen. So even again, if you're not in that process, you want to have a mindset of, I want to try to do things the right way. I want to try to paper and do my processes in a way that if they're subject to scrutiny later, that they'll, withstand that scrutiny. If you're actually thinking about doing an M&A process, my advice to you would be, you want to start planning early. So, if Liana, who was on the prior panel, if she hears in a boardroom that one of her companies is thinking about selling, a lot of times she'll call somebody on my team. And we'll want to talk to the company early on and say, hey, who knows where we might want to start thinking about pulling together a data room. You may want to have us start looking at your key contracts to see if there's anything in there that we're going to have to navigate. It might make sense to scrub your corporate records to make sure you've been doing things okay. A seller's always in a better position if they can identify issues up front, fix things if things weren't done quite the right way up front. But if you can present it to a buyer either as fixed or control the messaging around an issue, you're in a much better position than if a buyer's counsel discovers an issue, has an aha moment, and suddenly you're being reactive to that issue as it comes up. So again, if you're starting a process,
That was a lot of good insight. And I'm going to pass it along to you, Emily. I know that Mike covered a lot, but just giving you some of our founders in terms of things that they need to focus on from a due diligence perspective. I know Mike listed a lot, but even also too, what are some things that you've seen that people haven't done and created issues for them?
Sure. So I think what is often shocking or surprising to sellers is how deep that process goes, like how much they are going to turn over every rock. And I would say be prepared for, and we've talked about this in a previous panel, resourcing, right? If you're going to go through the M&A process as a seller, this is going to feel a lot longer and a lot more invasive than you expected. Whatever it is you expected, it's going to feel longer and it's going to feel more invasive. And it's going to take a lot of time. And as a sort of startup, you may not have the ability to turn to a lot of resources to help you get your house in order. So I'd agree with Michael very much, starting as you mean to go on makes a lot of sense, but also perhaps think about it from the buyer's perspective. Trouble if they miss something. So I would think about what kind of questions are the buyer going to ask me? Like we have, for instance, an awful lot of agendas on due diligence calls from underwriters, which give you a very clear picture of sort of all the areas that are likely to be looked at, all the questions that are likely to be asked. And if you look at that list of questions and you can't answer any of them, then we probably have a problem and you need to think about it. So I would say get a very clear picture, and it depends who your buyer is, right? A private equity buyer will assess you in a different way than a strategic buyer will assess you. They're looking for different things. They care about different things. So I would say the best thing to do is understand your buyer, understand why they're asking all these questions, make sure you know the kind of questions that are going to come down, and any one of us on the panel could help you with that. Sort of getting an understanding of literally what do those questions look like and how you expected to answer them. And again, as was alluded to, documentation, right? The big problem is the buyer is not allowed to just sort of take your word for it. So they really do need some, however nice you are, they need some kind of proof. And if you don't have minutes from your board meetings, or there is that guy in the office that's been a bit of a problem, but we haven't really done anything about it, that's going to come back to haunt you to the point where it affects how much money you get. So I would say always think about it from the buyer's perspective, and always assume it's going to be worse than you think. Just to counter how optimistic I was earlier.
Well, that was from both of you, that was a tremendous amount of insight for our audience. And I want to pivot just a little bit to you, Kiki, in terms of how can startups be more attractive to buyers for acquisition offers? I know I've had people come up to me when they know that I'm on the board of the NASDAQ Center and say, you know, I'm interested in selling my company. What can you tell me? I'm like, well, our center does something a little different, but it would be interesting to hear from you as someone who has, you know, gone IPO and done this. What are some of the ways that you think that people can appear more attractive? And also, too, what are some things that can harm startups' M&A prospects that they might not be thinking about?
Yeah, so, you know, I mean, obviously, initially, I would parrot everything that Mike and Emily just said about preparation, organization, you know, taking the time to be prepared to answer those questions and deal with the level of scrutiny. I think Emily used the word invasive, and I think that is a great word for how this process can feel. And it, and so as part of that, and I think maybe what I'll touch on a little bit here, just as a slight tweak on that, is you want to put your best foot forward. And a lot of that for sure is, do you have good corporate governance? Do you have your documents in place? Have you been doing things right from the get-go? But it's also about you. It's about what aura or energy are you as an entrepreneur projecting to the buyer? Like, and I've bought a lot of companies, and so I'm always sitting there thinking, like, is this founder someone that I think is going to be an incredible add to our business? Are they transparent? Are they honest? You know, how will they fit culturally with, you know, how we think of our business? And it's a two-way street too. Like, you should, like I'm gonna say, you should also be thinking about, is this, you know, for me, after this acquisition closes, what is the role that I want to play in this company, or the role that I can play in this company? And think about that. I absolutely agree. In tough markets, buyers will look for excuses to drop their initial price offer. They'll look for issues to subject to escrow, special escrows or special indemnities to reduce their overall cost of the transaction. But I also think fundamentally, in a buyer's heart, they have conviction in this company, right? Like, we're not buying you for no reason. It's because we believe that you are going to be additive to our overall strategy. And that is more than just, you know, just a product fit. It's a cultural fit. And so I think very highly of, you know, entrepreneurs that are transparent and are honest and are thoughtful about where they've invested, where they haven't invested, where they know their strengths are, their weaknesses. Buyers don't expect perfection. Disorganization, haphazard management, the appearance of that sort of thing will be off-putting to a buyer, particularly a strategic buyer who buys a lot of companies, who's very good at assessing, is this someone that I want as part of my family? And so I think, you know, you've got to think about, how do I put my best foot forward? It's more than just being prepared. You got to be prepared. You've got to be organized. But you also want to think about, you know, the people that you put in front of the buyer. If you have a product leader that's, you know, knows about the process, but is sort of disgruntled about it, you have to think about how to temper, you know, in those meetings, you know, that kind of perspective. How do you make this look like a win-win for everyone? Because that's what we want at the end of the day as buyers. We want win-win. We don't want to feel like we're buying a problem.
I think what I wanted to do too was also to ask Mike, just kind of to add on to that in terms of maybe some examples. You were talking about, Kiki, the way that people can stand out and really be a good acquisition target for M&As or for strategic buyers. Mike and even Emily, are you able to provide any anonymized examples of some of the pitfalls you've seen your clients experience in the M&A process and how those could have been avoided, obviously without naming names?
I will say what I thought was really interesting that Kiki said, and that I've also found to be true, is if everybody on the sell side isn't pulling together, right? If it is not a positive experience, and it was alluded to, and again by Kiki earlier, M&A isn't necessarily a win for everybody, right? In the same way that an IPO is. And I think if you have part of your team who is not thrilled about the prospect of M&A, or if some of the board is unsure about it, that comes through really clearly to the buyer, and it makes it very difficult if there are parts of the seller's team who sort of don't want it to happen or are ambivalent about it. We've seen situations where they will and can very easily put a big old spoke in the wheel. So I think having everybody's buy-in and everybody excited about the opportunity, otherwise that is going to come through, and that's going to come through in the diligence.
Yeah, and I think we keep saying these are all great points, but they are. And that's why this is a cool panel to be on, because we do this stuff every day and we see these things. So I don't want to toot our own horns too much, but like if you're hearing themes, it's because these are themes that exist. And so I echo all of these points. You know, a couple of other pitfalls that I thought were worth highlighting. And you know, we've been talking about, you know, what Emily was just touching on, and Kiki, you know, the seller putting their best face forward and making sure everyone's rowing in the right direction. One of the pitfalls I've seen on more than one deal is where there's not clear alignment between the buyer and the seller on terms, for instance. And so, you know, a lot of times there will be initial outreach, you know, from a buyer. If people feel like, oh, this feels like, you know, a good opportunity, the buyer throws out a price that's interesting for whatever reason, right? It feels like, okay, this makes sense, right? Maybe we should do something here. One of the things that I tell all of my clients, whether it's Kiki on the buy side or somebody on the sell side, is, you know, hey, great, we're there on price. There's a lot of other things we need to work out. So why don't we spend some time before we get too far down the path talking about some of these other terms? Really think about what that price means, and is it going to be subject to adjustments? Think about some of these other really material terms. Is this a cash or a stock deal? Is it a stock deal? Are you getting liquidity? What sort of indemnity, you know, downside protection is the buyer going to insist on, just so we're all aligned? And there's market around these things. And so you can use the time at the start of a deal, once you nod your head on price, to say, okay, let's spend a week or two getting to the other terms that people care about. And you can get there if both parties are motivated, get there and get to reasonable outcomes. One of the worst things that can happen, and every time I've said this to the client and they, you know, didn't follow this advice for all sorts of reasons. It's not that they were wrong, right? But for whatever reason, they didn't follow the advice and said, no, we want to sign the exclusivity now. We want to move forward. We'll work it out. It's really, really challenging, because instead of having the principals sitting around the table, you know, trading on points and working through things, you end up having the lawyers driving a process and negotiating through 100-page documents, and you lose the principal's attention. And if you're on the sell side, that champion on the buy side may turn the car keys over to the lawyers, and it's just a very different dynamic. And this is coming from a lawyer, right? But it's real and it's true. And so trying to make sure there's alignment on the key things up front and everyone's nodding their heads is really, really important. I think one other pitfall I've seen, and it's not really a pitfall, but it's a reality of these deals. We've been talking about the diligence process. I talked a little bit about terms there, but it's also calibrating expectations on the process itself, the timing, how hard it's going to be, how long it's going to take. I've seen a lot of situations, particularly on the sell side, where, you know, the corp dev person and the buyer will tell the founder, this is great, we're all set, this will be easy, we'll be done in 3 weeks. You're never going to be done in 3 weeks. But they plant the seed. And so suddenly there's this expectation that it'll get done quickly and it's going to be easy. And it's really not. And the outcome, you know, you'll get there. If the deal makes sense, you'll get there at the end of the day. But the path from the start until the end is very unpredictable. A lot of things come up. It always takes longer than people expect. And trying to, I do my best to try to level set with my client and be very upfront what to expect, so that they know it's going to be a long process and they know it's going to take some time. Because when you're 3 weeks into a process and you you in your mind, you thought it was going to be done, and you still have 3 weeks ahead of you. That can be pretty tough, especially when you're trying to run a business at the same time.
I just want to thank you upfront for going through that, because I know immediately I was thinking about negotiation and laying out the fact that coming to agreement on the terms and understanding what that is upfront, along with any other things that may be important to the deal, I think is a great amount of information and insight for our audience. So thank you for that. And again, just shows why you all are on this panel and are the experts in the space. We've been talking a lot about how you can really make yourself as a company, put your best foot forward in terms of an M&A process or even understanding the IPO process. But I really am going to shift totally and ask Emily about warrants and insurance, which is a little bit of a different conversation. So Emily, can you discuss how reps and warrants insurance works for our audience and how it is beneficial to a seller, and how does M&A readiness impact its availability?
Sure. And first off, Michael, that was a really great point. And every time I've seen someone sort of push off something that was on the LOI to be discussed later, it became a massive problem later. So I think you're 100% on the money there. So apologies to everybody who knows all about this already, but in a traditional, or the way it used to be, is the buyer would come in and they would offer you $100 million for your company. And they would say, but we're going to keep $5 million or $10 million back for a year or 2 years or 3 years, just in case any of the reps and warranties that you've given us that we're relying on and a part of the valuation of the company turn out to be wrong, we're going to keep that money. What rep and warranty insurance does is it insurance. So install the buyer an insurance policy. And so then if it turns out post-close that any of the reps or warranties that the seller made were wrong, or in fact the seller was fraudulent in any way, instead of turning to a holdback, the buyer goes directly to an underwriter. The reason that it's beneficial to a seller is obviously it provides you with an incredibly clean exit. Right. While there may be specific issues that come up or known issues that come up, and there'll be potentially side indemnifications for those, you get most of your money, if not all of your money, up front. And you also know that if there's a problem, depending on how it's structured, they're not going to be knocking on your door. So it's positive for reinvestment. It's positive for handing money back to your investors. And it just gives tremendous peace of mind. This was something that was pushed and developed by private equity because it initially gave them the ability at the end of the day to compete with corporates, but are a little slower, by saying, we'll give you more of your money up front and we can do this process faster because we're not going to spend months negotiating the indemnity provisions. Became very popular, and many corporates follow in that. So I would say it is valuable to both the buyer and the seller for multiple reasons. And I could do a whole boring hour on that. But from the seller's perspective, it basically gives you an incredibly clean exit and peace of mind and more money up front. And who doesn't love that?
And I'd want to say one thing. I promise you, on the sell side, if you don't negotiate that up front, you're never going to get it. So to the point I made earlier, right? That's a really key term that you want to talk about before you sign up to a 30 or 60-day exclusivity, and you're kind of in the soup.
100%.
Thank you for that, Emily. And Mike too, and just in terms of your additional information too, that was extremely helpful. And I want to go back to what you said after the great informative pieces of information you provided around understanding the terms and really getting things in line before you start the negotiation. You said you have to do all of this process and still run a business. So keeping that in mind, I want to ask you, Kiki, can you discuss how that does all of this process affects your company's ability to run a day-to-day business? And can you give any advice to our audience and founders on how to navigate that?
Yeah, look, I mean, not gonna lie, it's a distraction, right? Like it is, it's a significant distraction. It's hard. It takes a lot of time and energy. It takes some emotional energy too, just depending on the circumstances of the situation and how you may feel about it. So I think my first piece of advice is, while it may be tempting to bring a lot of people into the tent to help you with the process as long as possible, I think you want those people focused on running the business, because you aren't necessarily going to be at your best during this process about doing that. And again, you know, I would try to stage it and really bring people in. You know, you don't have to bring everybody in all at once. You can bring people in, you know, kind of time after time. You know, we sort of said sometimes deals don't go anywhere too. And so I think when you bring a lot of people in at the beginning, you can spin them up unnecessarily and get them defocused on the critical aspects of running your business. So that's why I think it also, you have to be savvy about how you tell people and when. But you know, for the core team that's aware, and I think this is, you know, kind of Mike and Emily have both touched on this, you need to make sure that you are all on the same page, that you are sharing, you're sharing information, you are aligned on the objectives of this process. You know, that kind of transparency and direction is critical to having a seamless process. You know, as a general counsel, it's hard for me to negotiate when like a CEO is having conversations maybe with his CEO counterpart and not necessarily relaying all of that information back to me. And so, you know, the folks who are working on the deal kind of have to know the totality of those circumstances, and you have to be open about those things, even when they're not great. And even when some of it may be, they don't see a role for you after this closes. You've got to trust that people are going to do their jobs. But I think having, you know, that kind of dialogue is really important. And I think, you know, and we haven't really talked a lot about the board's involvement in all of this. And that's one of the things I would say. I think your board's involvement in an M&A process is very different than the board's involvement in an IPO. They're both a lot of work for the board, which may be new for your board, but they're different types of work. And again, and I think, you know, Mike probably alluded to this a little bit too, having clear objectives, direct conversations with your board, you know, understanding what your board's expectations are for kind of setting those parameters, those lines in the sand, that will really help when you have to make a decision, a critical decision about, do we move forward, yes or no? What are we going to ask for here, yes or no? It just, that clarity of purpose will really make the process smooth, and that will help kind of let, you know, the smoother the process is for you, the easier it is to sort of manage the fact that you're not focused on your day job.
Would any of you want to add to that too? I know I had a question here. I'm just going to tell the audience about themes, but I think that we've been talking a lot about themes throughout this conversation. So did you all want to add to anything else that Kiki said about just ability to run that day-to-day advice? Emily, did you want to weigh in? I know, Mike, you had said some things earlier, so just wanted to give you an opportunity there.
Just really, because it is a painful, time-consuming process, it really is why it makes sense to have your house in order before you start, right? Because trying to pull it together after the process has started, when there's everything going on, is going to be practically impossible. So I would say sort of anything that, if this conversation makes any of you go, maybe we should deal with the blah, 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 then I would deal with the blah, blah, blah right now.
Before I ask you all for major key takeaways, I do want to go to our audience and take a few questions, if that's okay. So, first questions, and this is from a anonymous attendees. What are some of those provisions that we should be most mindful of? Did anyone want to jump in here first on that one?
Well, why don't I start on that? Just because I deal with these term sheets on a daily basis, right? And how they translate into a document. So, and this will be, these will be things that matter to all of you a lot if you're in these processes, particularly on the sell side, right? So the obvious one is price, but like I said, there's price and there's price because there's always adjustments to the purchase price. There may be expectations of delivering a certain amount of cash, having an understanding that your price will be subject to adjustments for expenses and debt and other things. Like I said, I see a lot of deals right now between two private companies where one private company is issuing stock to another private company, and how does that work, and how do our cap tables fit together, and what might that mean? So that's kind of one fundamental term is what does someone actually want to pay me for my company, and how does that really pencil out at the end of the day? Another term that relates to that that's really important, it's particularly important for founders and kind of key people within an organization. One of the things that when the Sumo Logics and other buyers are looking at technology companies, part of what they're buying is the technology and maybe the customers, whatever the case may be. But a big value driver for a lot of these buyers is the talent and the people. And like Kiki said, that's why putting your best foot forward and really letting the buyer see and get excited about you beyond just what might be on your balance sheet is really a critical piece. But that term is often that's relevant here is a lot of times the founders are and key people are asked to sign up to what we call a revest, where they say, venture investor will give you your dollar. For the founder, I'm going to give you 50 cents today, and the rest of the 50 cents you'll get over 2 or 3 years. And that's a big deal, right? But it's real and it's a key term. And that's, again, one of those things that when I have that call with my founders at the start of a process, I'll go through a list of what some of these key terms are. And that's one we often spend a lot of time on because I would say it's customary, it's standard in the market, but it can be hard to get your head around as to why am I being asked to sign up to this? You're being asked to sign up to it because the buyer wants to make sure you don't take your money and retire to the beach, right? But there has to be some trade-offs on trying to strike a reasonable balance. Emily talked about indemnity and rep and warranty insurance. That is a key term, and you can spend a lot of time, just like she could spend an hour on rep and warranty insurance, I could spend an hour on indemnity. We're not going to do that, but that's a really critical term because the price tells you what you're going to get up front, and the indemnity tells you what the buyer can pull back. And so that's a really, really critical aspect. And so that's just 3 examples. There's a handful of others that I would really want to focus on, if you're at that early stage and you're trying to get clarity. But those are 3 of the most important ones that would be important to this group and for people to internalize that point of, it'd be great to figure out some of this stuff before I get too far down the path.
Thank you, Mike. Another question that we have here is, have certain industries been isolated from the larger macro trends in M&A and IPO?
Emily, would love to get your take if you have any, because I think you probably have a broader scope of the market.
Yeah. I think we've seen a lot of where we are seeing activity still happening, and I think continue to see is healthcare. That is a sort of a necessity that never goes away. We're seeing, for instance, a lot of consolidation in oncology from private equity. We're seeing a lot of consolidation around sort of smaller doctor practices coming together. That seems to be less affected by the slowdown. I think, hospitality is still not what I would call front and center. And tech, there are certain parts of tech that are, remain. We still see a lot in sort of the semiconductor space, but SaaS is pretty quiet right now. Those are the ones that speak to me. And then, manufacturing is manufacturing. And people are always going to need consumer goods, no matter how ugly it gets, right? So I think those are less impacted. That's where we're seeing more activity. But definitely healthcare, which seems to be a constant roller coaster, seems to be still very positive right now. But I'd be interested to hear what Michael and Kiki have also observed.
Yeah, I don't have much to add to that. Again, my principal focus is in the technology space, right? And I think we've heard a lot about that, and a lot of my thoughts earlier on, were primarily through that lens. Kiki, I don't know if you had anything to add.
Specific question for you. How expensive is such insurance?
How long is a piece of string? So there are definitely, there are certain numbers I can give you, and there's both traditional and there is a new version of rep and warranty insurance that's interesting and a lot cheaper, but needs to be considered very carefully. So the traditional right now, how much you pay depends on how much cover you buy. It doesn't relate to the size of the transaction. Right now, we're looking at sort of 2 to 3% rate online, which means for a $10 million policy, you're paying between $200,000 and $300,000. That's a 6-year policy that covers general reps for 2 to 3 years and fundamental reps for 6. There tends to be a minimum premium, which is going further and further down. And I would say for that more traditional product, you're probably looking, if the amount of coverage that you need is sort of less than a couple of $1 million, then it may not make sense, because minimum premiums are sort of $120,000. And then there's a diligence fee and taxes. The other end of the spectrum, there's a new product that is entirely synthetic reps. So instead of shadowing the SPA, there are a set of pre-agreed reps that that the buyer enters into as a sidebar and says, if there's a breach under any of these reps, then we will respond. The positives of that are that you can get $1 million of coverage for 60 grand all in. There is no diligence call. You can do it for companies that don't have audited financials. However, there is a sizable gap, right, between what is necessarily in the synthetic reps and what is in the SPA. So I would say it is a very interesting product, and we have a lot of interest in it for the much smaller side of the transactions, and might be interesting from a small co-investment perspective. But it is very different, not easier, but very different than the traditional coverage. So I would say pricing can run anywhere from $60,000 to $100 million, but anywhere in there.
Thank you, Emily. Next question. So this is to you, Mike. What we're agreeing to in contracts that may be reviewed as part of diligence. What are the biggest red flags for buyers in those? I think we talked a little bit about those, but.
Yeah, sure. I can touch on some of those, and some are obvious, and one in particular is less obvious, but it's really obvious. Ones are things like a non-compete, most favored nation pricing, a sort of provision that could continue on post-deal and impact the buyer's business. And so anytime we're always looking for those, we have, within our organization, there's a group of people on a transaction that will be involved in looking at that, and they have their tick list of things to look for, right? And those are some of the obvious things to look for and pay attention to. And where it gets really tricky, and where, again, it's not as obvious, is that, you may say, well, it's fine for me as a startup to sign up to this non-compete because I'm never going to do this, what they're worried about. I'm never, I can give them most favored nation pricing because I don't have that many customers and it's easy to do. But a lot of times those provisions are written in a way that they don't just govern the startup itself, but they can reach into a term we often use as affiliates, right? But the parent company, subsidiaries of the company. And why that matters is once a buyer buys a company, that company becomes an affiliate of the buyer. And it's a legal term, but it's someone that's under common control or controlled by someone. And those affiliate provisions can have drastic consequences. Without naming names, I was on the buy side of a transaction for a very large technology buyer. That technology buyer agreed to pay $300 million for a target. When we were doing diligence of its patents against an 800-pound technology giant and said, we think your patents infringe and therefore X. And they ended up negotiating a settlement with the 800-pound, gorilla company that involves some licensing and other things. But that 800-pound gorilla doesn't like people suing it for those purposes. and drafted a document that basically said, we'll agree to some licensing arrangements, but this will apply to you and any of your future affiliates. And there's limitations on your business and for your future affiliates. And what happened with that target was the target was using a litigator to assert its patents. The litigator agreed to a settlement agreement. And once we learned it and we dug into it, my client walked away from the transaction because my client's entire IP portfolio, which it invested heavily in, which drove a lot of value, would suddenly become available for free to this 800-pound gorilla because of something that this startup agreed to, advised by an IP litigator who wanted to, make some money by asserting these claims. So that's an extreme example, but that happens and people care about it. And on the buy side, you spend a lot of time looking at those things. And so, again, my advice to everybody is, you want to be thwarted, have some legal help looking at those contracts and thinking about those things as you sign up to them. And the reality is you may need to sign up to them for your business right now. And so, I'm not saying don't do something that doesn't make sense for your business in the moment, but it's just important you're cognizant and thoughtful. And if you're getting some guidance from somebody that understands those issues, they may be able to help you massage some words or do some things that will make it less of a challenge if it comes to a point where you're going to sell yourself in the future.
Can I just add, I think the other one that I look at a lot is if you have some key contracts, right? Key supply, key customer, key vendor contracts, and those contracts have termination in the event of a change of control provisions, like that's often very hard for a buyer. If you're dependent on that contract and the buyer doesn't necessarily know how that vendor or partner or customer will feel about this transaction, that's going to add to the process. And so I would try to avoid, in those real key contracts, committing to kind of easy termination provisions in those instances.
Thank you both. We have 2 more questions. Here we go. Any emerging trends or best practices on ways to structure earnouts from a buyer's perspective?
Don't
do it.
All right. Anyone else?
Kiki, you want to try that or want me to try? Or
Emily,
you may think about it, but I don't know if you think too much about earnouts in your world.
No.
So look, as a lawyer on the buy side, I do not like earnouts because they are hard. They're hard. So what I always say is if we're going to do an earnout, it's got to be very, very objective, like something that is very easily definable and very easily measurable. Because again, you are in a situation where a year after closing, these people are your employees. They're valuable members of your family. They've worked really hard. You don't want to necessarily be in a position where you're having to disagree with them on some sort of subjective earnout about whether they met some sort of product delivery criteria that, they think they've met and you think they haven't. And it just can breed real discontent long after you've closed a deal and thought it was incredibly successful. So I'm always very clear with my engineering and product teams. We're going to do an earnout. It's got to be a number. And I know that like CEOs, they love let's do these 9. I once had a deal where we had 9 different metrics for an earnout and they were all subjective. And I was like, this is going to be cuckoo. And a year later, we were having, they were friendly disagreements about how to interpret these things. So please try to be as objective as possible. That's my ask. Your lawyers will thank you for it.
I would say there's a reason that earnouts are not covered by rep and warranty insurance, because they are so contentious, and I have heard them referred to as just deferred litigation.
Yeah, I share in all of those sentiments. And some deals you need to do them, right? And for those that aren't familiar with the concept, the idea is we'll pay you, 50 million today, but if you are able to achieve X, Y, and Z, or if X, Y, and Z happens, we'll pay you more. And that's the earnout concept. Sometimes it's a financial metric. Sometimes, like Kiki said, it could be a product development milestone. It can be structured in all sorts of different ways. But I always give the same advice to my clients. What you're asking for is a dispute. You want to be really, really clear. On the buy side, you want to be really careful that you don't tie your hands where you commit to, we'll invest in the business and we'll do this and we'll do that. And we'll ensure you can spend all your time working toward the milestones because you want to have as much flexibility as you can with the business you just bought. On the sell side, you want the complete opposite. You want the buyer to commit resources. You want to be able to dedicate all your time to hitting those. So upfront, it adds can add a significant level of complexity. It can add a significant level of us versus them from going into a deal where what you usually want in a buyer is everybody's aligned and it makes integration better. And you want to be able to have the team that just came on board, put them within the organization where it makes the most sense. And earnouts create really challenging differences of incentives right at the start. And I think it can really spoil some of the benefits of a transaction that a buyer and a seller are both hoping to realize.
Thank you all. That definitely sparked a lot of excitement just now. I have to say that. Last question. Is there anything new that CFOs requires for M&A, and what is the anticipated developments in connections with CFOs reporting? I think I'm saying that correctly.
CFIUS.
It is.
Okay.
I think that's CFIUS. So people who aren't familiar with CFIUS, it stands for the Committee on Foreign Investment in the United States. And basically, it's an organization made up of a lot of different agencies within the U.S. government that are very focused on national security concerns. And this is an evolving area. We have a team of experts that anytime these come up, I pull them in on transactions to help because it's, as with a lot of things in the government regulated space, there's not always bright lines onto how to navigate it and how to find your way through the process. But the punchline is what CFIUS provides is that for deals that could give rise to national security concerns, and essentially those really relate to a non-U.S. buyer, and this applies in financings as well. This is not just an M&A issue, but if a non-U.S. investor or buyer comes in to buy a company that's involved in developing technology or products that could give rise to national security considerations, the government can intervene. And even after a deal is done, if they find out about it after the fact, they can unwind a transaction. And so it's an area of great importance. It's an area where, again, it's evolving that, in the past, it used to be voluntary filings. Now there's a whole series of mandatory filings. It relates to highly technical definitions of what is critical technology. It's not always clear what applies and what doesn't. Had a call with a client the other day, or not a client, with a colleague the other day about a deal I'm working on where, it was does CFIUS apply here? Because it wasn't a clear-cut case where it might apply. And we wanted to make sure we got it right. Ultimately, you can have fines up to the purchase price for a transaction. The transaction can be unwound. So again, it will be a topic for a whole nother session with someone other than me. And, Kiki, you may have some thoughts. Emily, you may have some thoughts on it. But the punchline is it is evolving. And so if you're in any sort of transactions where you may be involved with a non-U.S. buyer investor, you really want to talk to your counsel to get some guidance, because you don't want to do something that is going to create problems for you either in the deal or even in the financing down the road.
Any other insight? Anyone wanted to add on that? Okay. It looks like here on the chat, and we are coming up towards the end, but there was another question. It is general, but I'm going to rephrase it a little bit. This person is looking for kind of the best way to start in terms of they're interested maybe in doing M&A for their company. So do you give any suggestions on where they might start? obviously the M&A process encompasses a lot of different players. So some people might go to a boutique firm or something, but they're looking for some suggestions on where they might start if they are a potential target, besides their personal network. So
Yeah, look, I mean, there are a lot of merger agreements out there in the world that you can read. And one of the things that I think would be valuable is go to your space, find, you probably are aware of a deal in your space between a large strategic buyer and a private company that might have been material enough for that, large strategic buyer to file it. Sumo, I mean, we certainly filed, a couple of one of our private acquisitions. It was material when we went public. And you can read it and you can see what it looks like. I honestly just think some self-education about what an M&A, what a merger agreement looks like. Because you'll see like, oh, I have to be able, it's like Emily said, like, I have to be able to answer all these questions. Like, I have to know, like, people ask about what kind of provisions and contracts should they be concerned of. There's going to be 2 pages in that document that say, do you have any contracts that include these provisions? They're great resources. You can find them. They're pretty vanilla. I mean, even if you can't find one particularly in your space, you can probably find one in a slightly adjacent space that will work just as well. Your law firm is a great, I all the time will just be like, hey, Mike, do you have a checklist? I just want to think about these things. And you can ask, and they will always happily provide, general checklists or agendas. Like, I have a standard agenda for like, what are the questions I ask in my first diligence session? Like, and I got that from a law firm. So I think there's a lot of resources out there in the world for folks, to find, to kind of start educating them on that process. But then again, it's like, start putting your ducks in a row. Like, again, I think big theme today, as much as you can plan and as much as you can prepare, the better off you'll be. And I would do that, as someone on the inside here, it's risk assessed, right? Like, what are my biggest areas of risk? And am I prepared to answer the questions or explain the clear plan that I have for how I manage these areas of risk, right? Like, if you're not selling internationally, maybe export compliance isn't a big area of risk. But if you have government contracts, you better be able to talk to those government contracts and are there provisions in those government contracts that would be problematic to a buyer? So, your company better than anybody else. I mean, and that's the advantage of, like being internal and being an entrepreneur, being inside the company is like, it better than anybody else. You know it better than the buyer. You know it better than your law firm. So you're the best person to start thinking about how to start, not someone else.
anyone else?
That was great.
That was awesome. And with regard to that, Kiki, just because I am going to start with our last 3 takeaways, did you want to provide your final takeaway to the audience today?
I had so many. I think we've hit on so many of them. So maybe I'll take a totally different tactic, which is it's okay to have feelings. Like, it is really okay to have feelings about this process. And I think particularly, as a founder or as a CEO or as a leader of an entire team of people, it's good to understand your own feelings. It will help you relate to your employees, and it will help them make them go through the process in a way that is successful for all of you. So embrace the feelings.
Mike?
Yeah, I agree. There's a lot that could be said. And Kiki, I really like what you just touched on. This is going to sound a little self-serving, but it's not fully self-serving. And it gets to the question that Kiki asked about what to do. And I think one of the things that I always tell people, and it's not just my clients, it's friends that call me, whatever, they know what I do for a living. And I think one of the really important things you need to do if you're going to get into one of these processes or even thinking about one of these processes is find someone you trust, an advisor who's been through it before more than once and can help you and hold your hand. And that could be, somebody within your network. That could be, someone at the law firm that you're working with who you can say, I really need to talk to someone that knows how to do M&A. That could be a director or venture capitalist on your cap table that's been through this before. And one of the reasons I say you've been through it before is everyone knows someone that sold a company, and that person, that if you call your founder friend who sold their company, they have one point of reference, which is the one deal they did. And they're not going to know all the ins and outs. They're not going to know all the circumstances. And finding someone who you can trust, who can guide you and support you and answer your questions and be there for you is really, really critical to help you through the process. It is, I love what you said about feelings, Kiki. You know, this is an emotional roller coaster. And I hope from this conversation, we didn't scare all of you off from M&A, right? Everyone you're talking to loves M&A, and we do this for a living, and we're good, nice people. So it's not like, you know, you should be fearful of this process. It's just more of again, setting expectations. It's a challenging process, but you want someone that's been there before, that can help you, that can guide you, that has good judgment, that can help you think through the issues and associate, you know, in your mind, how do I want to handle this issue? What are my choices? What are my options? I often find on these deals that I am as much a legal advisor as I am a psychologist, right? To help clients deal with those issues. You have started a company, you have built a thing, you have a team, you feel responsible for them, you have investors, you have a family. There's lots of dynamics here beyond the words on a page and what a term sheet says. And having somebody that gets that and can work with you and talk to you and help you through those things is really, really critical to helping you through what's a very challenging and demanding, but ultimately at the end of the day, for many, many deals, a very rewarding process and outcome.
Thank you, Mike.
All I would add is be really sure you know why you're selling, right? Like, what is your end vision, and what are your walkaways? Because once it starts, it's going to get really confusing, and you'll get lots of conflicting opinions, and something that you thought was terrible maybe sounds like a good idea now, and maybe I should do this. So I would have a very clear vision of why you're selling, what makes this a no-go, and you know, and if you're selling because you're tired, that's a bad idea, right? You're going to get more tired. So I would say have a very clear idea of what's important to you and what matters and why you're entering this process in the first place.
Thank you all so much. This was an amazing panel. I think our audience really enjoyed it, loved the questions, loved the conversation. And I'm going to also thank you for allowing me. I was honored to moderate this panel today. And I'm going to pass it along to Nicola.
Roberta, Emily, Michael, Kiki, this was just exceptional. Thank you so much. Thank you for bringing a human-centered design approach in many ways, not to use an overused word, but to a very complex and scary process for so many founders. We really appreciate that. And I also think I want to take a moment to appreciate all of our panelists today for saying, well, there's much you cannot control in the environment. Reflect on what you can. Reflect on taking a moment to realize why you're doing this, how to build a network of expert advisors and supporters who've got your back on the good moments and on the hard ones. And just realize that even if it feels like you're going slow, you're going for the right reasons. And checking in with yourselves and your team and everyone else that you need to in this process is an important part of the experience too. To all of you joining, we're so grateful for your time and your insights and perspectives. If you missed any of the sessions today, don't worry. We've got you. We actually are doing this live on YouTube, and we're going to be sharing the recordings and sharing all of the information. And if, again, you want to connect with any of the experts that you heard today, you can do that in the chat, see that link and fill it out. And I've got one last ask, because we wouldn't be doing our job if I didn't leave you with one ask for the center. And that is your feedback. Your feedback helps us get wiser and smarter about what more you need on this topic, most importantly, and also what else you're dealing with right now that we can be building responsive, supportive programs around you for. So to all of our sponsors, to all of our donors, and to each and every one of you, thank you. Thank you for doing this hard work of being incredible entrepreneurs in this world. We need you now more than ever. And we look forward to seeing you again very soon.